to the European market open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Cold water. Stocks trade mixed after Fed officials reiterate the need to raise rates higher for longer to quash inflation. Powell speaks today. Let the chips fall. Apple considers dropping a key Broadcom part from its devices in favour of its own homegrown semiconductors. Plus, buyout targets. Qatar is said to be looking at Man United, Liverpool or Tottenham Hotspur for a possible deal after hosting the most expensive World Cup ever.
Tom, this is, they got a taste for it. This is the picture for futures. A bit of pressure with European stocks 50, of course, down some 0.7%. I have to say, we look at some of the hawkish comments we had from Raphael Bostic, Mary Daly, and then it's really all about that inflation report on Thursday. Let's take a couple of days off. It's Thursday.
Yeah, that is the key. That is the key data point. Yeah, we're on Tuesday, Thursday, but that is where the focus is shifting already, and arguably a bit of profit taking then across these markets ahead of that CPI print on Thursday in terms of giving a clearer direction as to the Fed steer. And yes, we did have those officials coming out, non-voting members, but nonetheless, the view that you're going to get 5% or above and held for longer. Bostic saying for quite some time in terms of keeping that terminal rate above 5%. So the significance for these markets, of course, we continue to weigh up what is happening in China. A bit of a pause in terms of the reopening trade list across equities, slightly different when it comes to iron ore, and I'll unpack that story briefly in a minute. Currently, the FTSE 100 down 0.4%. Interesting to hear from the chief economist at the BOE, changing his tone, arguably slightly softer tone when it comes to what he's seeing, what the team at the BOE are seeing in terms of inflation, edging slightly lower from the chief economist at the BOE. Consequential there. The CAC gone over in France, down 0.4%. Over in Spain, losses of 21 points. Let's switch it over then, see how things are playing out cross-asset. The S&P failed really to hold significantly above 3,900. It's just above there now in terms of the futures. Mike Wilson, of course, from Morgan Stanley, suggesting there could be further downside, potentially up to around 20% downside, down to 3,000 for the S&P because of these recession risks, arguing that the optimism at this point around the earnings picture is overdone. The pound currently at 121, again, on the back of those comments from the chief economist at the Bank of England. We watched the pound, 121, just down 0.2%. The benchmark stateside on the 10-year, currently 355. Not a great deal of movement ahead of that CPI print. Iron ore, this is one of the bigger movements around the asset classes, at least, closing into $120 per troy ounce, or a ton, I should say, currently up 2.4%. Again, tying into the China story, some officials in Beijing saying that maybe infection rates have peaked in the capital, following from the PBOC chief, or like Secretary General, Guo Shiqing yesterday, saying that China's economy will normalize. Bloomberg Economics now, by the way, suggesting that you could see 4.8% growth out of that economy later this year. Francine.
Now, Tom, we do have some breaking news. Goldman's actually no longer forecasting a euro area recession. I was, in my holiday reading, surprised looking at the energy market, the fact that Europe is now in better shape than it was just a year ago. Now, let's get over to our Bloomberg MLive managing editor. He's Mark Cudmore. And Mark, good morning. You're looking at Latin America.
Yes, Fran, that's quite a big news, I think, on Goldman's change of view on Europe. But I do have another optimistic story here, and it is on Latin America. I am a bull on the EM story in 2023. I've picked LATAM as the one where local rates really look most attractive in terms of you being rewarded for the risks out there. So this is 6 countries, a chart of the benchmark policy rate minus the country's consensus CPI forecast for 2023 on Bloomberg. Now, I've brought it back to 2021, even though the CPI forecasts back then probably weren't too accurate, but it doesn't matter too much because how accurate they were. The point is, in 2021, they used to be all pretty much the same. We've just come out of a 13-year period where there was no rates differentiation. Of course, then the inflation wave hit in 2021, and Latin American central banks reacted, and they reacted aggressively. Brazil absolutely at the forefront. The point is, they got way ahead on this inflation story. And now, they now offer very, very generous real yields. In Brazil, almost 900 basis points, the benchmark rate above consensus forecast for CPI in 2023. Almost 500 basis points in Mexico, more than 300 basis points in Colombia. In contrast, the 3 countries at the bottom are 3 developed market countries. You've got Japan, almost 200 basis points negative yields, and Europe and UK, deeply, deeply negative yields. The general story is, if you believe in this global disinflationary story, well, then these yields have a long way to come down. Central banks will cut rates, and that will support their economy, support growth, support their stock markets, and, of course, provide generous returns for bondholders. And whereas these central banks will be lucky just to keep rates on hold. On the other side, if inflation proves more persistent, these central banks might get away with holding rates, whereas that means these ones will have a lot more to do. So it's very, very clear where the reward is for bonds in 2023.
Okay, Bloomberg MLive managing editor Mark Cardinal making the case for emerging markets then this year. Thank you for that analysis as ever. Now, Fed officials see further rate hikes in store ahead to above 5%, as we were saying before, pausing and holding at that level for some time. Atlanta Fed President Raphael Bostic reiterated the central bank's commitment to tackle inflation, saying they will have to hold their resolve. San Francisco's Mary Daly said it all depends on inflation data.
Starting point is the SEP, putting it between 5.25 and 5.5 if memory serves. That's a reasonable place to start, but we're going to need to go in and imagine as the data roll in, do we need to go higher or can we stop a little earlier? I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that, but that's where I'm putting it right now.
Okay, joining us now is Mads Pedersen, Human Edge Investment Technology Chief Investment Officer and Founder. Mads, good morning. Thank you for joining us. We will get your views on that Goldman call that actually the Eurozone is going to end up in growth territory at the end of this year. But first, let's stick with the Fed then, given the sound bites we just heard there from Mary Daly and, of course, the comments from Raphael Bostic. Are the markets prepared for a terminal rate of 5% and above through 2023 into 2024, or do they not take the Fed and these officials at their word?
I think they do take the Fed and the officials at their word. And I think everyone is quite nervous today because Powell is going to speak and he has not exactly been kind to equity markets when he's been talking the last 6 months. I think, of course, if we go above and every time we get closer to go above, there will be nervousness in markets. But I don't think we're in a situation where taking rates to 5 or 5.25 will destroy the year. If that's what you think, that could be the big blowout. Compared to how much was hiked last year, these are small moves.
Mads, overall, last year was really about falling valuations. What's going to be the big theme driving markets this year?
Well, I think it's still going to be inflation, but last year there was a case being made in the beginning of the year that you could not get inflation down. And even if you hiked rates, you could not get inflation down. The big positive surprise over the last 3 months and the last 3 weeks, aside from the Chinese U-turn, which we probably talk about later, has been that inflation has been coming down. I don't think anyone anymore doubts that inflation can come down. Now it's a question of how much it will cost to get it down, but inflation has turned. It will remain a big story because there is still, from the central banks, a lack of willingness to take a balanced view of inflation at the moment.
Mads, what is your view then on this Goldman Sachs call around 0.6% growth for the Eurozone this year, that moving it from negative territory, their forecast, and the implications then for the ECB and whether or not that forces the central bank in Europe to have to over-tighten? I know that's one of your risks.
Yeah, it doesn't force them to over-tighten. Nothing forces them to over-tighten. I think what gives the risk that they will over-tighten is that they know that they got it wrong on the one side and they don't want to risk to be accused of not having tightened enough. So they're serving their own service like that. If we look at the Goldman call, it's a significant headline call. I think it's likely that the Eurozone will be growing at the end of the year. I understand. I've been an economist doing these forecasts myself. I understand the message here is that things are not as bad as they look. I do think that Europe is probably in recession at the moment, so it's a little late to come with that call. But I see the message being the same as my general message is, we don't need a big, strong recession to calm down inflation. And therefore, the ECB can move ahead because there's growth, but nobody expects the ECB now to have to double rates from here, even though some of the members have been flirting with it. And I think what Goldman says is that you shouldn't be as negative as you were before.
So, but does it mean, Mads, that you actually come in and buy certain asset classes in Europe?
Yes, we are buying. The one we have been buying as late as yesterday a little bit, but the one we like is European high yield, for example. There is value. We have been buying it for a few months. So that's our preference. It's seen in a general situation where we're buying global equities and also sustainable equities. But in Europe specifically, I think the relatively high ratings means that we buy high yield relative to longer duration, you have to ask yourself, do you buy the spread? Do you buy the duration? And how much do you trust the central bank? And we trust that companies will pay back in high yield more than we trust that ECB will stay calm.
All right, Mads, thank you so much. I have to say, you also have a very cool poster behind you. I can't make out whether it's a beer or actually an automobile. So you'll have to make
it's
it wiser.
It's an old Löwenbräu, yeah.
There you go. Okay, Mads Pedersen, Human Edge Investment Technology Chief Investment Officer and founder. He stays with us. Now, coming up, Apple goes its own way. The iPhone manufacturer is said to be moving to in-house designs for some of its most important chips. We'll have the full story next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to the Open. We are 12 minutes into the European trading day. You're seeing losses now of around 0.7% across the benchmark. Fed officials making the point that rates could go higher from here, 5% or above, and for longer, arguably. And also, there's a case to be made that maybe there's a bit of profit taking ahead of the CPI print on Thursday. Futures in the US pointing lower by between 0.2 and 0.3%. Technology, by the way, one sector also in the red, down a little over 1% here in the European session. Now, Bloomberg has learned that Microsoft is in discussions to invest as much as $10 billion in the company behind ChatGPT, the viral artificial intelligence software. In other tech news, Apple is said to be planning to drop one of its biggest chip suppliers to use in-house designs. Apple is Broadcom's largest customer, making up around 20% of the American chipmaker's revenue in the last fiscal year. Right, joining us now is Bloomberg Quick Take correspondent Alex Webb. Alex, why is Apple ditching at least part of the input from Broadcom?
It's fascinating the way you've seen Apple develop over the course of 15 years or so, that under Steve Jobs, what they did is they really integrated forward. They built their own retail shops, everything that went as far as they could, getting very close to the customer. What we've seen under Tim Cook is they've been integrating vertically in the opposite direction into their supply chain, developing more and more of their chips. So we obviously know the sort of A range of chips, A13, A14, those sort of things. Those are the processors, the core components, which they now commission TSMC to manufacture for them. They're gradually spreading out beyond that. And the thing that lets them do is ensure that that all these chips play really well together, work more smoothly, provide better performance. Ultimately, Samsung makes its own chips, so Apple is kind of, ensuring that it has a competitive edge, it thinks, against its Oppo.
Talk to us about Microsoft.
Yeah, so Microsoft's investing in OpenAI. It's already the biggest investor, we think, in OpenAI. The ChatGPT tool, which they unveiled recently, has been called by some a Google killer. Well, what is the biggest competitor to Google? Still a very, very small one. It's probably Bing, which is Microsoft's search engine. So if it can take some of the OpenAI tools and build them into Bing, perhaps, or even just more sort of less sexy applications such as chatbots that companies use for their websites. All those sort of applications could be very lucrative for Microsoft if it can get, and it does for some of these functions, get exclusivity on OpenAI's product.
I mean, I read that piece, about Bing, and I was like, who uses Bing? I mean, I was forced to use it in China because we were blocked from using Google and everything else. When the VPNs went down, you had to use Bing. It's terrible. It's beyond that, isn't it? Surely for Microsoft, they're going to revive Bing on the back of this?
Well, but Bing still exists, and actually, if you use DuckDuckGo, which a lot of people use to try and avoid using Google, that's actually powered by Bing. So Bing does have its fingerprints out there. I think it has close to 10% market share, as you say, still considerably less than Google search. It is fascinating, though, because, Google does have its own chatbot capabilities. They're not, as publicly revealed as ChatGPT. This is going to have huge implications for the search market, partly because the way that Google works is that if you're searching for a product, it isn't necessarily in Google's interest to serve you one result, the perfect one every time. It wants you to be able to see ads. So how you get an ad product to work with, a very efficient it might not be, but effective AI tool is going to be a fascinating question.
How much was it valued, like ChatGPT at 27? I have a problem is that the 11-year-old now says, I don't need to do homework, let's just ask ChatGPT.
I'm sure that conversation is happening in many households.
Not verified.
Yeah, it's valued at $29 billion, according to this reporting, 10 billion input from Microsoft. It's already, as we said, a sizable investor in the company. People were asked, some people did some reverse of envelope calculations on how much it was costing OpenAI to run ChatGPT as a beta. It's in the order of millions of dollars a day. So then sit there and go, well, how are investors going to make money from this? Well, here's your answer. You have Microsoft putting money into it. There are also reported some private sales where existing investors are selling down their stakes to new investors. So there is still an opportunity for ChatGPT's backers to make some dollar.
Alex, thank you so much. Bloomberg Quick Takes, Alex Webb, they're focusing, of course, on all technology stories. Now we're back with Mads Pedersen, Human Edge Investment Technology Chief Investment Officer and Founder. Mads, when you look at technology, again, 2022 was the year where we saw a big sell-off, huge job losses in tech. Does it come back in the next 18 months?
I would think so. I think it's a sector which has taken, of course, a evaluation adjustment, we can say, but it hasn't taken a bigger adjustment than many other sectors. Just look at our own industry, asset managers, for example, hasn't been a good story either. I don't think they're going to go away. I think that what we see is that these companies are repositioning for the market, which we all know is going to be there, which is the big market for information, but also for the cloud. And I think we all will be more and more dependent on some of these. So I don't see technology investments going away, just like I don't see pharma investments going away. And I see these growth sectors playing a larger role when the first part of the recovery trade has played out. The beginning of this year was obviously European beaten up stocks jumping up. I think technology and pharma, for example, which is almost a little bit different from that, is probably a better long-term play.
Mads, which segments, though, of tech would you want to be focused on as you look to that recovery? And can tech really take the lead once again?
Well, per definition, tech can take the lead once again. 120 years ago, we called railways technology. I don't think the railways are going to take the lead in the UK, especially, as we hear at the moment. But technology can take the lead, and technology will probably take the lead. I don't think the sector is the same as it was 20 years ago, and that means that these companies are larger, they are more growth focused on internal investments, and they are more transforming our society. But it is a situation where money has a price again, and therefore growth has a value, not growth without generating revenue, but revenue generating growth. And these companies have shown they're extremely good at that.
Mads, are you surprised that actually as interest rates rise, and we heard Mary Daly, of course, of the Fed saying, look, this could go to even 5% in terms of interest rates, that we haven't seen more defaults, that we haven't actually seen, I mean, there must be parts of the markets that are over-leveraged, but nothing really ugly has happened yet.
Well, we have seen something in the crypto space which wasn't too pretty, which you could call defaults. But of course, nobody had lent them so much money because there was so much private money. I am surprised a little bit on the positive side that defaults have been so low. And that led me to look into what's driving it. And I think it's very interesting to see how high the ratings are with high yield at the moment. And it's obviously where we see most of the defaults. And with the very low financing terms, I think we have to accept that for any given scenario, it will not be that way the economy cleans out. Defaults will be lower in this cycle because the average rating or the median rating of a high yield company nowadays is BB. It didn't used to be that high. So it's surprising, but it's a sign of relative strength.
Yeah, so switching focus to China then, and we're seeing a little bit of profit taking across Chinese markets today, but since October, the Hang Seng is up, what, 50%? Is there more to run on the reopening theme around China?
I think there's definitely more to run both on China, global growth, and on and also on the equity market globally, and probably in China, it's a bit more high risk, of course, in China. But if you look at a 5-year horizon, China hasn't made up any of what it lost before. And what we have seen happening over the last month is very dramatic. I had some interesting conversations during the ski holiday, which we celebrate quite intensely here in Switzerland. There is snow up on the top of the mountains with China experts. And even the most insightful people, I've only followed China for 25 years, but some people have followed for longer, are surprised at the speed and the decisiveness of the opening up and the coordination with the economy. So I think there's more to go on a cyclical positive here.
Okay, further to go for the reopening theme around China as you gauge the views of China experts on the slopes of Switzerland. Mads Pedersen, thank you very much indeed. Have a great rest of the week. Human Edge Investment Tech Chief Investment Officer and Founder. Right, coming up later, the World Cup is over, of course, but Qatar looks to spend more on the beautiful game and could potentially being the new owner of your favourite Premier League team. Stay with us for the details. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open, everyone. 24 minutes into the European trading den. We're seeing a little bit of pressure. A lot will depend, of course, on what we get on Thursday with that inflation print in the U.S. And then we had two pretty big Fed speakers, and both comments were actually seen as hawkish from Raphael Bostic and Mary Daly. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. A third member of Sam Bankman-Fried's inner circle is said to have met with U.S. federal prosecutors seeking a cooperation deal in the fraud case over the collapse of FTX. Any deal with former engineering chief Nishad Singh would leave Bankman-Fried isolated after the FTX founder pleaded not guilty last week to 8 criminal courts. Singh has not been accused of any wrongdoing. Bloomberg has learned Apple will ditch a key Broadcom chip from its devices by 2025 as part of its push to use more homegrown components. Sources say Apple also plans to have its own cellular modem chip in action by about the same time. Apple is Broadcom's largest customer, accounting for around 20% of the chip maker's revenue last year. Bloomberg sources say BHP Group has struck a deal to sell Australian coal to a Chinese firm in the latest sign of easing trade curbs between the two nations. Sources say BHP sold 2 shipments of metallurgical coal to China Baowu Steel Group for loading in late January. China slapped an informal ban on Australian coal in late 2020 as relations soured. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. Time to check in on some of the movers. One of the stories that Laura hit on there, of course, was the story around Apple and its attempts to replace at least some of the chips from Broadcom by 2025. So the read across then for some of the chip makers, STMicro gets about 20% of its revenue from Apple. The other story in the chip space, of course, is TSMC revenues missing for the first time, quarterly revenues in about 2 years. STMicro, listed in France, of course, currently down 0.6%. Euronav, big drop there of 20%, listed in Belgium. It's a shipping company. The news on this is that an offer from Frontline, a voluntary conditional exchange offer for all outstanding shares of the shipping company will now not be made, so a hit there to Euronav. Covariant, this is a deal as well, an upping of an offer there. Triton coming in with an offer above Bain Capital's offer in November, so gains there of close to 20% for that Finnish company. Francine.
Great movers. Coming up, higher for longer. Fed officials dash any market hopes of a potential pivot. We discuss the rates outlook next. Of course, we'll look at euro-dollar, what the impact on treasuries is, and of course, markets worldwide. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Cold water, European stocks and U.S. futures drop after Fed officials reiterate the need to raise rates higher for longer to quash inflation. Jay Powell speaks today. Let the chips fall. Apple considers dropping a key Broadcom part from its device in favor of its own homegrown semiconductors. Plus, buyout targets Qatar is said to be looking at Man United, Liverpool, or Tottenham Hotspur for a possible deal after hosting the most expensive World Cup ever. Now, Tom, let's look at the markets, although we really just want to talk about football.
We would love to talk about, but we're going to get into that story, of course, that bid, potential bid from Qatar. They are ironing up some of those EPL teams. We'll see what is in line for them. Across the markets, though, you are seeing a bit of profit taking, arguably, then, ahead of that CPI print Thursday in terms of what that will give us in terms of the direction. So currently down 0.6% on the benchmark. Of course, you did have those speakers coming out, Mary Daly, Raphael Bostic, 5% or higher potentially. Mary Daly even suggesting could be held through 2024. And Bostic saying at least for a long time in order to get inflation back down to that 2% target. So investors digesting that as well. A bit of a pause in terms of the reopening trade in China. Mark Cudmore over at MLive thinks that will be just a very brief pause. He very much thinks there's going to be a lot more optimism and bullish sentiment around these Chinese markets. Here in the UK, the FTSE 100 down 0.3%. The CAC 40 lower by 0.6%. The DAX in Germany off by 39 points. Let's switch it over, see how things are playing out across the sectors then. Energy currently leading the gainers, just up 0.2%. Energy also gaining 0.2%. We'll check in on Brent and WTI. Brent currently down 0.3%. WTI back below $75 a barrel. Across the commodity space, there is a standout. That is iron ore, getting 2.5%, tying to expectations of additional demand for China. Check on your markets there at 8:32 in the city of London. Fran.
Now, Fed officials see further rate hikes in store ahead to above 5% before pausing and holding at the same level for some time. The San Francisco Fed President, Mary Daly, sees a range between 5.25 and 5.5, adding it all depends on inflation data. Well, joining us now is Max Kettner. He's HSBC Chief Multi-Asset Strategist. Max, good morning. I feel like every week there's a Fed official saying, like, look, just because of the nature of this inflation, if you're going to hit it hard to get to that target, then we will end up at 5.5%. And every time it feels like it's a surprise to the markets.
Yeah, I think we're probably getting closer to the stage where it won't be that much of a surprise, because when we look at the peak rate that it's priced now, it's close to 5 already, right? It's like when we look at sort of 3 month, 1 month forward, 6 months, 1 month forwards, you're already starting to see that sort of very close to 5%. And then at the end of the day, at least if you look from a cross-asset perspective, you look at credit, equities, rates, everything in tandem, you say, well, does it matter whether we go to 5 or 5.25? Not really, right? Probably the bigger story would be, oh, we go to 7 instead of 5. And that looks unlikely, very unlikely, right? So I think it's getting less and less of a surprise potential. I think the bigger surprise potential will be what Daly was saying, that in fact we could be seeing the Fed funds rate being held at that peak rate for much, much longer, right? But the key question now is the sequencing. Will the market first focus on the ultimately higher level of inflation in maybe 12, 18 months' time, right? So is the market already going to fret about that ultimately higher level of inflation? Or in the next 6 months, is it actually going to enjoy the negative rate of change, inflation really dropping pretty hard over the next 6 months? I think that's the key question. Which one is it? Is it rate of change or is it the level?
Well, where do you stand on that, Max? And particularly when it comes across and overlaps onto the earnings picture. You had a Mike Wilson over at Morgan Stanley saying, look, the markets are overly optimistic in terms of the forecast around earnings. You don't share that view, arguably. No. What is Mike Wilson and team getting wrong?
Yeah, I think, you know what? I think the sequencing is really the top priority right now, right? Is it really going to be the first half of 2023 that is the weaker part, or is it the second half? And I think the key thing that people are getting wrong, or perhaps not getting wrong, but what we are seeing now is a very, very concentrated consensus around that first half of 2023, right? I don't think you've had, very few guests who would say, oh yeah, first in 2023, we're going to see a bit more pain, but then things will become better. We think actually, because of that concentrated consensus, look at the Q4 earnings expectations. They've been downgraded massively, Q1 as well. Much in contrast to Q3 and Q4 this year, right? Where everyone is already expecting a recovery. But I would argue, well, if everyone's already expecting a recovery and earnings expectations haven't come down then, but earnings expectations have come down now for Q4 and for Q1, well, then the upside potential now is much greater than it is for the second half of 2023.
So Max, how much of a correction? There's a great chart that Valerie Teitel put for us looking at Morgan Stanley's Wilson and the fact that he's actually expecting that S&P to fall some 22% to 3,000 because of these recession risks. So what's your call on S&P?
No, I think by the end of the year, we'll be around about 4,000, but I think we'll probably get a bit higher first and then see a weaker second half of 2023, right? So we're probably going to get higher first and then see more pain for investors really coming in for risk assets in the second half of the year because of that concentrated consensus, because of, when you look at some of our leading indicators, most of them are either bottoming out or really showing definitive signs of slowly picking up. They're not great, right? They're not shooting through the roof, absolutely not. But we are starting to see that the incremental rate of change in macro is starting to be positive, right? Yeah. And what we also shouldn't forget is, as inflation is dropping, we could see an improvement in consumer sentiment. You're starting to see that already in the US, right? You're starting to see, with a little bit lower inflation, consumer sentiment and consumer confidence has been picking up, right? So as that is continuing, consumer sentiment could again be improving, and that's positive then for the next couple of months. But then in the second half, we'll realize, oh, that's not great, because that then means that the ultimate level of inflation is perhaps higher, and that then will probably force the Fed's hand again, and then the weakness comes in the second half of the year, not in the first half.
Yep.
Is there a risk that you're cherry-picking your data, Max? ISM services, that was miserable, wasn't it? I mean, and if you're not cherry-picking and you stick to that view, how do you allocate along that view?
No, I'm a strategist. I would never cherry-pick data, right?
So,
never. No, but I think the key is, so in all seriousness, I think the key thing really what we've seen is that it's not just one data point that is showing signs of stabilization, but it's global PMI models, it's input prices, it's China's credit impulse. It's really across the board where we are starting to see tentative signs of improvement. Now, to the ISM services, for example, I would say I'd be probably much more careful if it was still higher, right? Now that it's fallen, you say, well, where's the downside potential, right? It's already fallen, so now we know it, right? We know it, it's there, right? Do we have massive potential for this to drop another 10 points? Probably not, right? Now you look at all these sort of forward-looking indicators to explain PMIs and ISMs, and you're like, oh, in 3 to 6 months it gets weaker. But now we're at that point.
Max, one of the, I guess, winning strategies, right, for last year was this value investing relative to growth investing. Does that continue into 2023?
I think so. I think for the time being that will be still a value versus growth preference. So we still say Eurozone overweight, UK overweight, emerging market overweight, US less so, right? So we still got this value versus growth preference. But I do think there will come the point in the first half of the year where you want to switch that around, right? Particularly when you start to see, okay, now inflation is dropping quite dramatically, consumer sentiment up, where you want to start to pick up a bit more growth exposure, right? Not quite yet though.
Okay, so value for now, but the timing around growth is coming forward.
Yes.
Max, we were loving your energy. We've been talking about just how much energy you brought to the studio this morning. So thank you very much indeed. Max Kettner, HSBC Chief Multi-Asset Strategist. Right, coming up, deal doldrums. Yes, Jefferies' fourth quarter profit slumps 57%. We discuss earnings and the outlook for Wall Street next. This is Bloomberg.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, 41 minutes into the European trading day. Losses across European equity markets of 0.6%. Warning for Fed officials. You can see higher rates for longer. The CPI print, of course, out on Thursday. Futures in the US range bound across your sectors. A couple just in the green, clinging on to upside. Energy up 0.3%. Everything else really is in the red or range bound. Banking as a sector currently down 0.2%. And talking of the banking sector, there is some deal slump, of course, the deal slump, particularly around the trading business, the investment banking side of the business, and Jefferies reporting a 57% decline in its fourth quarter profit. Nomura, meanwhile, has seen an exodus of senior bankers in Asia. For more on the banking outlook, we are joined by none other than Bloomberg's Charlie Wells. Charlie, what do the Jefferies earnings signal then about the broader sector?
So Jefferies is really interesting because it's the first major Wall Street financial institution to report fourth quarter earnings this week. So it's going to be a bumper fortnight, really. So some of the major banks reporting later this week, but Jefferies is the first. And as you mentioned, it really indicates that there is trouble in deal land. So we're looking into this week asking, deal or no deal. It's looking like not a lot of deals. So of course, profit down 57%. You can attribute a lot of that to that investment banking slowdown, that deal-making slowdown. Revenues there were down 52%. But it's sort of a mixed picture because at least Jefferies beat expectations. So the consensus had been $550 million in revenue. They got to almost $570 million.
Charlie, we also had some breaking news on Nomura. So we had several senior deal makers leave Asia. Is that more of a regional concern, or is it Nomura overall?
Francine, that's a really great question. So the bank would say that that's more of a global issue, right? So they attribute it to that deal-making slowdown, to global pressures that they're facing. But of course, this also is an Asian story, right? So China, until very recently, had that COVID-0 policy. There are tensions with the US. There are a lot of concerns about how deals can be formed in that sort of environment. But then, of course, yesterday we had that great scoop about Goldman Sachs laying off 3,200 workers starting as soon as midweek this week. So of course, the bank is not wrong in saying that this is something of a global story, that this is happening, across the world.
You have to wonder with these layoffs, because of course the banks had to play catch up in terms of hiring with all the deal flow that came through during the lockdown periods. And yes, it's bleak now in the public markets, but it'll pick up at some point. Are they going to need to reach out and find talent again? And are we getting any sense of when deal flows pick up again?
Tom, that's also a really good question. And that is one of the kind of tricky balancing acts that these banks need to face where, if you lay off a bunch of staff, when eventually the cycle continues again, you'll face the same pressures that we're seeing in a number of other industries, which had to lay off a lot of people only to retreat later on. And so I think that, look, a lot of people are thinking about the financial crisis right now. They're thinking about the number of layoffs that we saw then. I think banks remember those years and they remember the struggle that they had afterwards trying to catch up. And so I think, look, with Goldman, the estimate estimate had been about 4,000 jobs, for instance. The number that we're getting this week is 3,200. So it looks like a sense of trying not to cut too much, but of course needing to keep those expenses in line as well.
All right, Charlie, thank you so much. Charlie Wells there with the very latest on the banks. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. A day after Brazil's capital was stormed by his predecessor's supporters, President Lula da Silva says there will not be a coup. He made the comments after holding a meeting with all 27 of the country's governors, including allies of the former president Jair Bolsonaro. A union representing UK ambulance workers says a strike planned for Wednesday will go ahead, calling a government offer of pay rises in return for productivity savings an insult. Prime Minister Rishi Sunak's government has been talking with union leaders across sectors, including health, transport and education, in an effort to stop a wave of strike action. French President Macron is risking upheaval with his plan to overhaul the country's pension system. He's going ahead with an election pledge to raise the minimum retirement age from 62, setting out the plans later today. The move could trigger mass strikes and protests when the French economy is already at risk of falling into recession. Engie has agreed to extend the life of 2 nuclear reactors in Belgium for another 10 years, a move which will help to boost Europe's energy security. According to Prime Minister Alexander De Croo, the French utility will begin permitting the process this week. After months of talks with the federal government, Belgium had been planning a full phase-out of atomic energy by the end of 2025. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. Right, coming up, new ambitions. A Qatar fund is targeting stakes in England's top Premier League clubs. We'll bring in details on which ones are being targeted. A bit of a clue there on the screen. Stay with us. This is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Welcome back to the Open, everyone. 49 minutes into the European trading day. For the moment, a bit of pressure on a lot of these stocks. We await Jay Powell's speech a little bit later, and then, of course, we look forward to the CPI data on Thursday from the U.S. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. A third member of Sam Bankman-Fried's inner circle is said to have met with U.S. federal prosecutors. Any deal with former engineering chief Nishad Singh would leave Bankman-Fried isolated after the FTX founder pleaded not guilty last week to 8 criminal counts. Singh has not been accused of any wrongdoing. Bloomberg has learned Apple will ditch a key Broadcom chip from its devices by 2025 as part of its push to use more homegrown components. Sources say Apple also plans to have its own cellular modem chip in action by about the same time. Apple is Broadcom's largest customer, accounting for about 20% of the chipmaker's revenue last year. Bloomberg sources say BHP Group has struck a deal to sell Australian coal to a Chinese firm in the latest sign of easing trade curbs between the two nations. Sources say BHP sold 2 shipments of metallurgical coal to China Baowu Steel Group for loading in late January. China slapped an informal ban on Australian coal in late 2020 as relations soured. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright here in London. Thank you very much indeed. We have a lot going on your agenda, of course. We touched on the CPI print out on Thursday. Let's get you up to speed on what else is happening that you should slot into your agenda, of course. Things to watch out for. At 3 p.m. UK time, we will have wholesale inventory readings from the US. Later today, Fed Chair Jerome Powell, BOE Governor Andrew Bailey, ECB Executive Board Member Isabel Schnabel, and Governing Council members Pablo Hernandez de Cos and Klaas Knot. Well, they are speakers at an international symposium at the Riksbank in Stockholm, so we'll be listening out for comments, particularly, of course, from Jay Powell. And also later today, the World Bank will release its Global Economic Prospects Report for 2022. Interesting that Goldman Sachs comes out with a revised forecast for growth out of the Eurozone of 0.6%. Francine.
Now, Tom, just weeks after the end of the 2022 World Cup, the sports arm of Qatar's sovereign wealth fund is said to be exploring buying stakes in 3 English Premier League clubs, including Man United and Liverpool. Well, joining us now is our UK business reporter. Of course, he's also an expert on sports and a Chelsea fan. He is David Hellier. So, David, first of all, I mean, you have some great scoops, and this was, largely thanks to your sources. Like, what do we know about why Premier League clubs are so much in demand?
I mean, basically, Premier League TV revenues are so much higher than anywhere else in the world. 10 billion over 3 years. No sign of this dropping, although the rate of increase has fallen a little bit. But the Premier League is I mean, now it's kind of almost conquered America. I mean, the TV rights deal there was 2 or 3 times the previous one. What the Qataris, what's fascinating about the Qataris is that before the World Cup, they the QSI bought a stake in a Portuguese team, Braga, in line with what is a developing trend in football. It's these big groups owning more than one club. And at the time, they were talking about more smaller type of clubs in Europe. What happened since the World Cup is that they've had a rethink. And they were saying, a source was telling me yesterday that they can't ignore the Premier League. It's unstoppable. So it is quite a major change on their front.
David, who are the key targets at this point then?
Well, I think all the clubs that are up for sale, and also Liverpool and Manchester United just happen to be the biggest clubs arguably in the Premier League, alongside Man City, so they are definitely, clubs that they would be looking at. It also emerged that Nasser Al-Khelaifi from QSI met with Daniel Levy, the Tottenham chairman. Tottenham has an amazing new stadium that is, the apple of everyone's eye, because they've done something incredible there that holds American football and boxing. And I think, it's an the team haven't won many honours, but they get big crowds. They're a historic club, so they're another one. I suspect Everton as well would be one that's being looked at.
So, David, why, I mean, how much money do these clubs actually want? The owners, I know there's a lot of talk about Man United and the Glazers, you know, wanting to sell it for a huge amount of money. So does this price out a lot of kind of domestic investors?
I mean, it's a good question. I mean, so Man United's share price, for instance, has been rising, you know, really, really quickly in the last few days. And so now, even on the market, it's valued around $4 billion. My sources have said that you really need to start with £5 billion, but you know, it could go higher than that. I mean, that's for a team that doesn't regularly make profits, although its revenues are 600 to 700 million a year. You know, Liverpool, pretty valuable too because of its historic nature, its fan base, all the rest of it. Maybe 3 to 4 billion.
David, just very, very briefly, any likely pushback, either from fans or from the government, indeed, to this proposed purchase of stakes, at least?
Yeah, I mean, so government, we've got the Tracy Crouch review, which was last year. It's kind of died a little bit, but I think with the current government, with Rishi Sunak, the soundings that they're going to take that seriously. Tracy Crouch wanted fans to be more directly involved, definitely.
Okay.
And that there will be pushback, but fans will be torn between wanting to own their club or have a say in their club and the huge riches that they, you know, see coming from a Middle East owner.
Hard to turn away from those kind of dollar symbols. David, thank you very much indeed. Great scoop. Thanks for the latest, of course. And we'll continue to watch that story. Across your markets, before we let you go, losses of 0.6% across the benchmark here in Europe. The FTSE 100 down 0.3%. Jay Powell will be speaking in Sweden at that Riksbank symposium later in the day, ahead of CPI print out on Thursday. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
is Bloomberg Surveillance Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Cold water, European stocks and U.S. futures drop after Fed officials reiterated the need to raise rates higher for longer to quash inflation, while Powell speaks later today. Let the chips fall. Apple considers dropping a key Broadcom part from its devices in favor of its own homegrown semiconductors. Plus, buyout targets. Qatar is said to be looking at Man United, Liverpool, or Tottenham Hotspur for a possible deal after hosting the most expensive World Cup ever. Now, first thing is first, so let's check in on the markets. I know a lot of you will want to know more about this football story, so we also have our sports guru, David Hellier, who broke the story for us, coming on the program a little bit later on. European stocks overall down 0.7%. This is largely also reflected in some of the S&P futures that we're looking at, down 0.2%. We had Raphael Bostic. We also had Mary Daly. Mary Daly, really interesting in terms of what she's expecting interest rates to be. Yes, around 5.2, even 5.5, but the idea is that they could stay higher for longer so that there's no Fed pivot, and again, the market getting used to it and maybe selling off on the back of it. Euro dollar 107.35. Let's also get into the European map to see whether, and I haven't seen so much difference between what's happening, for example, in Europe or in France compared to what's happening in the UK. Down 0.3% for the FTSE 100, the CAC 40 down 0.6%. Now, Fed officials see further rate hikes in store ahead to above 5% before pausing and holding at that level for some time. The Atlanta Fed President Raphael Bostic reiterated the central bank's commitment to tackle inflation, saying they will have to hold their resolve. Well, San Francisco's Mary Daly said it all depends on inflation data.
Starting point is the SEP, putting it between 5.25 and 5.5 if memory serves. That's a reasonable place to start, but we're going to need to go in and imagine as the data roll in, do we need to go higher or can we stop a little earlier? I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that, but that's where I'm putting it right now.
Well, joining us now is Eddie van der Valter, MLive editor. Eddie, what a treat to have you on TV today.
Oh, fantastic. It's so good to be back.
Less busy than usual.
Yeah. I'll tell you what, I feel like the year is really getting going this week. I feel like this is finally it.
This is it. And we had two Fed speakers.
Yeah.
I feel like it hasn't really changed in their tone. Is look, if we have to get inflation, interest rates are going to get higher for longer, but the market needs a bit of getting used to this.
You know what? Touch wood, touch wood. It feels like 2023 is a good news year a little bit, right? So far, the news that we've had so far has all been good. And don't forget, if the Fed manages to keep rates higher for longer, that is in actual fact good news for the market, because that means they've avoided a recession and they haven't been, forced into a painful period of cuts. And I think that's what people are missing. People are saying, okay, it's all going to be about rates and the Fed's going to have to cut in order to keep the stock market rally going. But if the Fed manages to keep the job market going at the same time as keeping rates high, then that means, the economy is still growing. The economy is robust enough.
Eddie, I mean, this is a lot of juggling. Like, what could go wrong?
Yeah, there is a lot that could go wrong. There was a lot that could go wrong at the end of last year, right? We still have China slowing down potentially on the back of, new COVID waves. Europe looks a lot better this year. We have avoided this worst case scenario of an energy crisis. But I think particularly the US, I think that is where the real focus is going to be, and whether the economy remains strong enough. Now, that jobs report that we had last week was very good news. The ISM, on the other hand, much more nuanced.
So, Eddie, when you look overall at some of the news, and this was the big Goldman Sachs call also this morning, no longer expecting a recession in Europe.
Yeah.
Does that change some of the calls you're seeing out there?
Yeah, and I think that's why we're seeing the dollar underperforming. I think, Europe, a lot of people had priced a full-blown energy crisis in Europe. It looks like Europe is going to avoid that, right? Energy storage capacity, natural gas storage capacity, well above 80%, and we're deep into the winter. We're not going to run out of gas this year. Are we going to be able to refill for next year? That's a different question. But for the time being, it looks like inflation in Europe is going to come down fast, and you're not at the cost of growth, which is the key factor.
So we have a chart actually tracking what one of the biggest names in equities have said, and this is a 22% correction when it comes to S&P 500. I mean, I know we're looking at some of the bullish drivers. I know you've been trying to look at some of the services data and actually what it means going forward.
The services data, of course, last week from the US was really bad. And you know what? I think we've got to be careful about separating the leading indicators from the concurrent indicators. And the stock market typically is a leading indicator on where the economy is going to be, 6 or 12 months from now, just like an inverted yield curve. So a lot of these indicators are showing us that perhaps we should be in a recession right now. But the jobs market says we are not. So I think we've got to cast a little bit of doubt on those forward-looking indicators, because the nowcast of the economy isn't where they told us we were going to be, and therefore I think it's a lot more optimistic.
Eddie, how much are we focusing on China? So again, there does seem to be a belief in the markets that we're going to see a lot of volatility, but that China this year will be a positive.
Look, there is no doubt that if the world's second largest economy goes back to work and is back in full swing, that is a positive for the world economy. Now, as you say, there's a lot of doubt, new waves. We had that in Europe. We saw quite often that, when you reopen, it's a stop-start process. But a China that is reopening and going into stop-start process is a China that is more active than one that is in complete lockdown. And therefore, I think Chinese demand is strong this year.
All right, Eddie, thank you so much. Great, terrific update from our Eddie van der Veld, our MLive editor. Coming up, Munich Security Conference, of course, the chairman, Christoph Hausgen, on Germany and geopolitics. That interview is next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this year's annual Munich Security Conference is due to get underway next month. In the 12 months since last year's gathering, Russia's invasion of Ukraine is posing defense challenges for Europe's decision makers not seen since World War II. Well, we're now joined by the chairman of the Munich Security Conference, he's Christoph Heusgen. Dr. Heusgen, thank you so much for joining us on Bloomberg. When you look at the last 12 months and exactly what Europe has lived through and the challenges posed by Ukraine and, of course, the war in Ukraine because of Russia, how has Europe done? If you had to give it a report card, what would it say?
I think that Europe passed, certainly, because this was a really a change in German and European history. We haven't seen an attack in the center of Europe like the one we witnessed last year. You know, the Munich Security Conference last year took place just a few days before Russia's invasion. We had President Zelensky in Munich, his last visit outside the country before he went to Washington last month. And he was appealing to Russia, you know, to find a peaceful solution. And the transatlantic community was strong in saying, well, if Putin does as our intelligence services tell us he will do, we will stand together. Putin went ahead. We saw this. I must say that we were in for a surprise for Putin, because Putin didn't expect first Ukraine to be as resilient as the country was, as the population was, as the president of Ukraine was, but also he met with a lot of resistance from Europe. He thought that we would be scared because of no more gas supply. We would be scared because of inflation. We would be scared because we needed to support Ukraine with lots of billions. And here we stand. A year after, we're standing strong.
But
Putin
Dr.
has
Heusgen,
been defeated.
Well, I mean, defeated, do you think there could be a regime change, actually, in Russia? Or what does the next 6 to 8 months? Russia has been significantly weakened,
we cannot change the system from the outside.
Right.
Yeah.
So what do you think
No,
will
we
happen?
cannot change the system from the outside. What we have to do is we continue to pressure, we have to continue to sanction, we have to continue to support Ukraine militarily, that they continue to beat the Russians and to reconquer some of their territory, so that the Russians gradually understand that they don't have a future with Putin and turn against him. You know, this has happened before in the history. You remember what happened to poor President Gorbachev or Khrushchev. They were put aside at a stage where you know, the Russian political elite thought that they don't have a future with it. And this is what we have to hope for. Until now, Putin stands firm because he is dominating the political scene. There is no media freedom, there is no NGOs, there is no opposition, but people feel the effects of Russia's isolation.
Yeah. Of course, what Ukraine needs now is money and weapons. The new Republican House majority has agreed on capping spending, of course. Would that imperil aid to Ukraine?
Well, I think this is what Putin is looking for. Putin is looking for signs of weaknesses in my country, in Germany, in Europe, and of course also in the United States. And so we have to look very carefully at what is happening in the United States. But I must tell you, we have had last year and during the course of the years many Republicans at the Munich Security Conference. And they were very strong in their support of Ukraine. So I don't see that there will be a wavering of support. But of course, we have to watch it carefully. And we followed, of course, what was said in the discussions last week, very painful discussions when you see this from the outside.
How long do you think this war will last?
It will last longer than we hoped it would last. Because Putin counts on our weaknesses. He counts on our population to say, well, that's enough. We force Ukraine, we force Zelensky into a ceasefire. And there we have to stand firm and we have to continue to support. And you have seen this week, Francine, you have seen the decision by the Americans, by the French, by the Germans to deliver tanks. And so we stand firm, and Putin will be in for more surprises.
Dr. Huisken, of course, in conflict zones, and we've never seen such high-tech weaponry and tanks being sent to frankly, almost any part of the world. But in conflict zones, when the conflict ends, there's always a worry of what happens to these weapons. Is now the time to think about that?
Now is time to support the Ukrainians with weapons. They have been very responsible in conducting the war, in using the weapons. You know, you are probably, as I do, following the news from Ukraine. This country stands together. They stand together in defending their country. They stand together in supporting their military forces. And I think the concern that weapons may get somewhere derailed, I think it's not a concern we should have.
Thank you so much for all of those insights, Christoph Huisken. They're the chairman of the Munich Security Conference, and of course, that security conference will be mid-February, and Bloomberg will be a big partner in that. Coming up in a bid to shore up public finances, the UK Chancellor cuts energy aid to companies. We have plenty more on that story next, and this is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
In the UK, the Treasury has announced it is cutting energy support to businesses and bringing in a new, smaller program from April. Now, joining us now is Bloomberg's Lizzie Burden in London with the very latest. Lizzie, good morning. So gas prices, of course, have been falling. How bad is this for business?
Yeah, they fell significantly over the summer, but remember, they're still triple the pre-crisis level, so businesses are still struggling with their energy bills. But the government has said yesterday in the House of Commons, it was Treasury Minister James Cartledge, that it's shrinking its energy support from 18 billion over 6 months to 5.5 billion pounds over 12 months. And the reaction hasn't been a happy one. The UK Steel lobby group said that UK steel manufacturers are now getting less support than German manufacturers, making them less competitive. And the Federation of Small Businesses has said that businesses are either going to go to the wall or have to cut jobs if the government doesn't cough up more money.
So, Lizzie, are we close to a deal for pay with union workers?
Well, it does seem that both sides are softening day by day. You remember over the weekend, the debate was about whether the Prime Minister would be open to the idea of negotiating on pay for this year. That's what the unions want. Or is it just 2023, 2024? But what we've heard from the big talks yesterday between the government and the union bosses is that the Health Secretary, Steve Barclay, seems to be willing to backdate pay, so kind of meeting in the middle on the time frame. And the Financial Times reports that potentially the government would be open to a one-off payment to help workers deal with the cost of living, something that you tend to see more in the private sector and the Prime Minister's spokesman has ruled out before. So another two options, but still we're expecting ambulance strikes tomorrow, nurse strikes later in the month. And so it seems like both sides want an off-ramp, but for now they're still trying to choreograph a way that both look victorious.
So we wouldn't probably get an agreement for the next 6 weeks, or, I mean, is it just impossible to say?
I'm sure we'd all love to say that the chaos could come to an end, but I do feel optimistic that things are moving. But remember as well, the anti-strike legislation is being brought forward today. So from the union's perspective, it's still a long way to go.
All right, Lizzie, thanks so much. Our Lizzie Burden there with the very latest on some of the things that we're seeing in the UK. Also, in the first sign of progress in a long-running dispute on post-Brexit trading rules, the EU has agreed to use the UK's live database tracking goods moving from Great Britain to Northern Ireland. Now, for more on all of this, we're joined by Bloomberg's managing editor for European economy and government. He is Ben Sills. Ben, good morning. So what exactly has been agreed?
So basically what this means is that the Europeans are going to be able to have a better idea about the goods that are flowing into Northern Ireland from Great Britain, so that gives them more confidence that the single market, which of course begins at the border between Northern Ireland and the Republic of Ireland, is going to be properly controlled. That's been the technical and political problem for both sides to solve, which is one of the issues at the heart of this dispute over the Northern Ireland Protocol.
So, Ben, how significant is this in the overall scheme of things?
Well, I think that there are still a lot of significant issues to be resolved before the issue can be laid to rest. However, I think it's significant because it shows a return of goodwill. It shows that the two sides can work together. It shows progress for the first time in months, and it shows that the arrival of Rishi Sunak after the brief and turbulent premiership of Liz Truss and the longer and just as turbulent premiership of Boris Johnson, it's like a new page in this relationship, and I think both sides are committed to getting a deal done in the next few months.
So, Ben, what exactly, I mean, the underlying, why is there such goodwill, I guess, on both sides? The Prime Minister, Rishi Sunak, was a Brexiteer right from the start. So is it to try and grow the UK, or do we understand their thinking in this?
I think that Sunak, although he was a Brexiteer from, before either Truss or Johnson, he was more of a kind of technocratic, vision on the issue. He's not been using Brexit in quite the same jingoistic fashion that Truss and particularly Johnson did, and I think that the Europeans feel they can do business with him on that basis. Plus, also we have the 25th anniversary of the Good Friday Agreement coming up in April, which could possibly mean a visit by Joe Biden to both Dublin and Belfast, and the British want to make sure that there's going to be nothing to disrupt that.
Okay, thank you so much, Ben Sills, their managing editor for Government and Economy. Now, we'll be also covering all things UK every week on Thursdays, 9:30 a.m. UK time for a half-an-hour special. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A day after Brazil's capital was stormed by his predecessor's supporters, President Lula da Silva says there will not be a coup. He made the comments after holding a meeting with all 27 of the country's governors, including allies of the former president Jair Bolsonaro. The French President Emmanuel Macron is risking upheaval with his plans to overhaul the country's pension system. He's going ahead with an election pledge to raise the minimum retirement age from 62, setting out the plans later today. The move could trigger mass strikes and protests when the French economy is already at risk of falling into a recession. ENGIE has agreed to extend the life of 2 nuclear reactors in Belgium for another 10 years, a move which will help boost Europe's energy security. According to Prime Minister Alexander De Croo, the French utility will begin the permitting process this week. After months of talks with the federal government, Belgium had been planning a full phase-out of atomic energy by the end of 2025. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, going it alone. Apple considers swapping a key chip component from Broadcom for one of its own. We'll have plenty more on that story next, and this is Bloomberg.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Cold water, European stocks and U.S. futures drop after Fed officials reiterate the need to raise rates higher for longer to quash inflation, while Powell speaks later today. Let the chips fall. Apple considers dropping a key Broadcom part from its devices in favor of its own homegrown semiconductors. Plus, buyout targets. Qatar is said to be looking at Man U, Liverpool, or Tottenham Hotspur for a possible deal after hosting the most expensive World Cup ever. So, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Fed officials see further rate hikes in store ahead to above 5% before pausing and holding at that level for some time. Now, San Francisco Fed President Mary Daly sees a range between 5.25 and 5.5, adding it all depends on inflation data. Joining us now is Ben Guttridge, Asset Management Director of Model Portfolio Services at Invesco EMEA. Ben, Happy New Year. Whether you're an investor and look at the new year and kind of say, look, well, I know that we're going to, touch 5% in terms of interest rates. What I want to know now is the timing of how long they stay there for.
Well, Happy New Year to you as well, and enter the year feeling relatively optimistic. Sure, the latest comments from the Federal Reserve have that reassert that hawkish inclination that they have, that higher for longer narrative. That's difficult for markets to perform well in, I think, but it's not about what the policy is communicating now. It's the action that is taken through the year, and if inflation does moderate, I believe so the communication and policy execution would moderate too, and I think markets would take kindly to that.
So Ben, let's also look at a chart actually looking at U.S. CPI. Now, the Federal Reserve, I know, is very data dependent, but at what point do they start actually also pricing in what they've done so far? So this is, data dependency, but also modeling.
Well, I mean, this is sort of a key question, and one that markets will be sort of fighting over in terms of market volatility. But you would have thought through the first half of the year, the pause should be clearly on the table, and it would be our anticipation that the Fed, at some stage, perhaps end of Q1, early Q2, will be communicating that a pause is coming on the back of moderating inflation, and whether the cuts come or not is uncertain. But that pause, we think, should be taken reasonably well by markets.
I mean, a lot of people are also talking about this Goldman call this morning, saying they no longer expect Europe to be in a recession. Now, it's debatable whether we're possibly, at the outskirts, really the fringe of recession at the moment. But do you see any value in Europe?
Yes, we certainly do see value in Europe. Certainly, the gas price equation is much more favourable. We think the ECB may have to reverse some of its hawkishness, as the inflationary trends don't seem to be quite so acute there. Certainly don't see it in the wage market. And then, of course, the China reopening story. Now, I wouldn't get overly excited about that. It's not necessarily that they're going to be like consuming lots of things out of Europe, but a reopening story in China is also a help rather than a hindrance, and therefore there is a better
travel. So what do you buy? Are there sectors that will benefit this almost directly?
Well, I mean, it's more of a domestic recovery story. So it's almost like a China A-share story, more so than perhaps a sort of sucking in lots of imports from around the world. I mean, it's more. There's more imports will come as a result, sure, but the delta we think is more domestic than international. But it's not a bad news story for Europe, and so I probably wouldn't necessarily go as far as the Goldman story. But given the valuation, I think Europe is interesting.
Value versus growth. Where are we on this in 2023?
Well, I think the money to be made is in the value markets. But given the concerns that we have around growth, on a portfolio construction basis, or perhaps being the cowards that I am, we sort of tend to revert to sort of a US equity position. We know it won't give you quite the bang for the buck if this good news story comes through, but given there are still a lot of uncertainties, then perhaps it's a better hedge.
Ben, the UK, I mean, we've had such bad news, frankly, in the UK. Is now the right time to buy in?
Well, it's certainly difficult news domestically. The market has been a relatively strong one compared to other major bourses, and that could well continue if energy markets remain elevated or revert to some price increases. But the UK domestic story does remain challenging, so I would have thought the large caps with that international earnings story, and now some earnings momentum looks like a better trade.
All right, so now let's also talk about tech, Ben. Bloomberg has learned that Microsoft is in talks to invest as much as $10 billion in the company behind AI software ChatGPT. Now, meanwhile, Apple is also considering dropping one of its biggest chip suppliers to use in-house designs. Let's bring in Alex Webb, our Bloomberg Quick Take correspondent who oversees all of our tech coverage. So first of all, Alex, good morning. Apple dumping Broadcom. I mean, how easy is this to do?
Well, clearly not easy, because it's something they've been working on for some time. They have been hiring people to work on essentially wireless communication chips internally. What they buy from Broadcom are the chips that communicate both with Wi-Fi and Bluetooth, noticeably not with mobile network. That's supplied by Qualcomm. So it looks like what they're going to do is ultimately, in a few years' time, Apple will have its own custom chip, probably manufactured under license by someone like TSMC in Taiwan, which can then unite all of those things in one place. The idea being then it would play better perhaps with a lot of Apple's other components.
So Alex, what does it mean for other chip suppliers? Or is this a trend, or do you really have to be one of the most valuable companies in the world to get away with it?
I mean, it's a trend at Apple, and of course Apple, for these companies...
Because they have the money.
So firstly, Apple has a huge amount of capital which they don't necessarily know what to do with. So sometimes what they do, or a lot of what they're doing, is investing in their own underlying technologies. That is meaningful for the likes of Qualcomm and Broadcom, for whom Apple's about almost a quarter of all revenue. These are sizable chunks of change. If they lose Apple as a supplier, it is one of the biggest players, if not the biggest, in the market, depending on what your market is. What Apple is doing is it has already integrated a long way forward in terms of having its own retail and distribution operations. We've seen over the past decade is integrating back into the supply chain and making it more of its own components.
So Alex, Microsoft, I mean, this $10 billion investment, which I think it's still mulling. I don't know if it's we understand that it's in talks, but that it hasn't really quite made the plunge. Is this a good deal? I mean, if you look at OpenAI, is this the big revolution going forward?
It certainly looks as though, if you look at the venture capital land, for instance, so much of money had been flowing into Web3 and all this sort of thing, and perhaps some had missed AI, which is, it is going to be a massive deal over the course of the next decade. For $10 billion, Microsoft's already the biggest investor in OpenAI. It could look relatively cheap at the price, actually, if you look in the long term. The question is how they use it. Is it going to be something which could make Bing a real challenger to Google search? Is it something which actually is just going to be going into things like chatbots, which they supply to all sorts of companies around the world, for customer service? There are lots of potential applications for this. It's worth saying, ChatGPT, GPT-3, which is based on, is far from perfect. It has a lot of problems. It is also just a beta, so there is going to be further development. This capital will help them do that.
Ben, have your kids asked to go on ChatGPT for their homework?
They haven't yet.
They haven't yet. I hope they're not watching. Kids, don't try this at home. Are you an investor in tech?
Well, we are by proxy of being favourable towards US equities. I think, some of these numbers obviously mind-boggling, but the long-term growth potential still looks pretty reasonable as far as we can see. And of course, our anticipation is that the Federal Reserve will move incrementally dovish as we move through the year. What happens over the next sort of month or so is clearly very uncertain. Certainly, they seem committed to being hawkish at the moment. But on a medium-term view, as the rate cycle comes to an end, and given the earnings power these businesses have, still favour US equities and tech by proxy.
So tech by proxy, anything, I mean, when you look at sector groups, for example, energy was the biggest winner last year. Does that continue into 2023?
Well, clearly there's some geopolitical risk in that trade. I would have that makes that sort of much harder to predict. I think if we think about a falling rates, a tougher economic position, a fading rates position on the long end of the bond curve, then I think areas like tech and defensive healthcare, those are sort of the areas that would be favouring, but certainly hedging that with some energy given the geopolitical risks.
Alex, I mean, I feel like the best part of last year we're talking about job losses in tech companies. companies. Has it plateaued? Is it going to be reversed, or are we just in a wait-and-see mode?
I think there's a lot of wait and see, yeah. I think a lot of companies have pushed job cuts through. There are a lot who haven't, and some of those who haven't are facing pressure from their investors to do so. So I think we're likely to see more. I wonder whether the lion's share for the big companies has already been done.
Okay, is there anything in particular that you're looking out for as really a kind of barometer of what tech companies do?
It is really interesting to see the news flow we're starting to see from the semiconductor companies. As that we saw this massive undersupply early in the pandemic, then we saw, it seems now, oversupply as they ramped up production capability. It is a bellwether for consumer demand in a whole range of different businesses. Samsung, we saw preliminary numbers from them, not very good. The implications then for Apple and others, there is some hesitation around that these companies which had proved remarkably robust through much of the pandemic, now starting to feel the pain quite a lot.
All right, thank you both for joining us. Alex Webb there, Bloomberg Quick Take correspondent, and Ben Guttridge, Asset Management Director of Money Portfolio Services at Invesco EMEA. Coming up, deal doldrums. Jefferies' fourth quarter profit slumps 57%. We discuss earnings and the outlook for Wall Street. That's coming up next, and this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacroix here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
ENGIE has agreed to extend the life of 2 nuclear reactors in Belgium for another 10 years, a move which will help boost Europe's energy security. According to Prime Minister Alexander De Croo, the French utility will begin the permitting process this week. After months of talks with the federal government, Belgium had been planning a full phase-out of atomic energy by the end of 2025. Now, a third member of Sam Bankman-Fried's inner circle is said to have have met with U.S. federal prosecutors seeking a cooperation deal in the fraud case over the collapse of FTX. Any deal with former engineering chief Nishad Singh would leave Bankman-Fried isolated. After the FTX founder pleaded not guilty last week to 8 criminal counts, Singh has not been accused of any wrongdoing. And Bloomberg sources say BHP Group has struck a deal to sell Australian coal to a Chinese firm in the latest sign of easing trade curbs between the two nations. Sources say BHP sold 2 shipments of metallurgical coal for loading in late January. China slapped an informal ban on Australian coal in late 2020 as relations did sour. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's turn to the banking sector, where the deal slump is hitting the bottom line. Jefferies has reported a 57% decline in its fourth quarter profit. Nomura, meanwhile, has seen an exodus of senior bankers in Asia. Now, for more on all of this, on the banking outlook, we're joined by Bloomberg's Charlie Wells. Charlie, so good to speak to you as always. So if you look at Jefferies, of course, earnings not great. There another discouraging or bad news from Wall Street. So who's reporting later this week?
Yeah, so later this week, we're going to see some of the bulge bracket banks. So Jefferies is interesting because it's early on in the week of this sort of fortnight of earnings that we're about to see, but we're going to see the likes of Bank of America, of JP Morgan, and they should give us a kind of broader picture of how the U.S. economy and Wall Street is faring. So Jefferies, of course, is primarily focused on investment banking, so we get sort of a segmented view of what's going on, broader picture later this week.
What about Nomura? So we had some senior bankers leave the Asia-Pacific region.
Those departures are striking, and I think they indicate that, there has been trouble in deal-making in Asia for a while now. We've seen other major banks have some headcount reductions there as well. I'm talking about Goldman Sachs, and I'm thinking Credit Suisse. But of course, the bank points to broader trends in investment banking that have been really hard on the sector. And so that, in part, explains why these departures may have happened.
So, Charlie, overall, and we're seeing, a cutting of the fat, or without, it's job losses. It's basically cost cuts. Is this because the banks grew too much in 2021, 2022?
This is difficult to talk about, right? Because it's real people, it's real job losses, of course. And yes, so there was an expansive growth in deal making over the course of 2020, 2021. We saw a lot of these banks really ramp up hiring. And now, as you say, this is kind of cutting the fat. This is a sense that, in some of these areas that really have kind of boom and bust cycles, including deal making, you scale up when the deals need to get done. Unfortunately, when the deals, start falling through, you have to scale back on the hiring.
But is it mainly back office that's actually, because it's difficult, right, to wrap up people? I don't know whether it's the rainmakers that actually bring the deals in that would
It's challenging, and I think what we're seeing is actually a more broad-based cut to a lot of these banks. What was really striking this week was, of course, the news about Goldman that Bloomberg broke, cutting 3,200 jobs starting this week, and those cuts were a lot broader than a lot of people thought. So this is not as specific as I think maybe people would have hoped.
Okay, Charlie, thanks so much. Charlie Wells there with the very latest on some of the banks. Now, coming up, new ambitions. The Qatar Fund is said to be targeting stakes in England's top Premier League clubs. More on that story next, and this is Bloomberg.
has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A day after Brazil's capital was stormed by his predecessor's supporters, President Lula da Silva says there will not be a coup. He made the comments after holding a meeting with all 27 of the country's governor, including allies of the former president Jair Bolsonaro. French President Emmanuel Macron is risking upheaval with his plan to overhaul the country's pension system. He's going ahead with an election pledge to raise the minimum retirement age from 62, setting out the plans later today. The move could trigger mass strikes and protests when the French economy is already at risk of falling into recession. A union representing UK ambulance workers says a strike planned for Wednesday, which is tomorrow, will go ahead, calling a government offer of a pay rise in return for productivity savings an insult. Prime Minister Rishi Sunak's government has been talking with union leaders across sectors, including health, transport and education, in an effort to stop a wave of strike action. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, just weeks after the end of the 2022 World Cup, the sports arm of Qatar's Sovereign Wealth Fund is setting its sights on the English Premier League. Now, the fund is said to be looking at 3 clubs to buy a stake in, including Man United and Liverpool. Well, joining us now is our UK business reporter. He's our football expert, David Helly. So, David, thank you so much for joining us. First of all, why are Premier Leagues so much in fashion?
I mean, the Premier League is just the league in Europe. The
gold standard.
The gold standard. Yeah, and I mean, I think possibly post-COVID as well, where, you know, all of football suffered during COVID. Yeah. But in bad times, you know, there's a sort of flight to quality.
Yeah. But so, David, the Chelsea sale, which you covered extensively, and I keep on saying you're a Chelsea fan. I'm not sure whether that's quite correct, but the amount of money they got for that club, it has changed everything, actually. So are sellers expecting so much more from their clubs now?
Yeah, definitely. I mean, people, you know, club owners who have been with a club for maybe 20 years, like the Glazers, have seen an incredible capital gain, and so they see an opportunity.
So not many people have that kind of money. Does it have to automatically? I mean, is it the Americans that have the money, the billionaires, and then the Qataris?
Yeah, I think you've got sort of two channels really. You've got incredible interest from America, because in American sports, clubs, franchises like Manchester United, they sell at 10 times revenue.
Oh.
In Europe, it's about 5 times the revenue at the top. I mean, you know, there are people, American investors buying clubs at 1 to 2 times revenue.
Oh.
Then you've got the Middle East money flows, and of course their interest was massively heightened during the World Cup, with Saudi Arabia doing so well, you know, hosted by the Qataris.
But so, and this is something that actually confused me, because I guess there are investment groups that want to buy more than one club, but there are rules also around it.
Yeah, I mean, at the moment that you can buy as many clubs as you like, except that there's 2 specific issues. You can't have 2 clubs in the Premier League.
Right.
But, you know, in the case of PSG, they're in the French League, and Man United would be in the Premier League, so there's no problem there. But the other money spinner for the clubs is the European Champions League. So in the European Champions League, essentially you can't own two clubs or control 2 clubs. But there's an exception to this. In 2018, Red Bull Salzburg played Red Bull Leipzig, and all the people I talked to say that set a precedent.
So, David, I mean, how 2023, is this really going to be the year where we're going to see a lot of these big clubs change hands?
I mean, I think so. It looks like it. I think Liverpool and Man United are very serious. Everton is up for sale. And the multi-club bandwagon is really advancing. So that's not just in England, but throughout Europe.
Okay, it's January. What football shirt are we getting? Is there a cool football shirt that we should be getting for 2023? Is this like the height of speculation of who will buy it?
Football shirts?
Yeah, should we get Chelsea? There you go.
Well, I love Chelsea, but I'd say also Venezia always come out with great shirts.
I know, they're voted #1. I mean, I didn't even know they had a football team, and that's on me, but there's not much terrain, because there's a lot of water. David Haley there, the very latest, of course, on football. Now, Bloomberg Surveillance Early Edition continues in the next hour. In the meantime, we're seeing a bit of pressure across equities. This is on the back of some pretty hawkish comments from Mary Daly, but also from Raphael Bostic. We look at Jay Powell. He'll give a speech a little bit later today. And then, of course, on Thursday, it's the big one. It's U.S. CPI. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is
it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that.
I don't think we're in a situation where taking rates to 5 or 5.25 will destroy the year. Compared to how much was hiked last year, these are small moves.
The Fed is actually not data dependent here. They're path dependent. That is not a setup for a soft landing, in my judgment.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Federal Reserve's next move. 2 Fed officials see interest rates rising above 5% as the central bank fights inflation. Summit in Mexico City. The leaders of the US, Canada, and Mexico meet to discuss everything from trade to migration to climate change. And Jefferies is the latest to fall victim to Wall Street's deal slump. The firm's profits plunge in the fourth quarter. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines is on assignment today. And Matt, we're dealing with another day where Fed commentary has poured cold water on risk appetite, it seems. And we wait to hear from Jerome Powell later today.
Yeah, absolutely. I mean, we're looking forward to Powell's statements, but what we've heard so far has made the markets a little bit less bullish, and as a result, we see drops really around the world in risk assets. Take a look at what's going on in Asia. The MSCI Asia Pacific is down, but only by 0.05%. So not huge drops there. The Hang Seng off about 0.3%, and Japanese stocks actually gaining about 0.8% overnight. Of course, the BOJ is in a slightly different situation than other central banks. The yen right now costs $1 for 131, almost 132 yen. So that's pretty stable compared to what we saw yesterday. It's when you get into U.S. stocks that you see futures weighed down a little bit heavier than what we saw in Asia. Well, actually, now that I say that, futures are unchanged on the S&P. So not too bad. It looks like a little bit of a recovery. And I wonder if there are people out there who were surprised by what Raphael Bostic said. I mean, of course, the Fed is expected to raise rates more than 25 basis points at the February meeting, according to market pricing right now. So that would point to a 50 basis point hike. That puts us at 5% already. And that means we only need one more hike to get above that. The U.S. 10-year yield at 354.85 right now, so up about 2 basis points as investors feel comfortable enough to sell that debt. Maybe that's why you see futures going back to unchanged. Gold right now, very little changed, also only up about 0.25%. 1876 a troy ounce is the level there. I chose gold because there's even less movement in crude, or at least there was about 10 minutes ago. And then Bitcoin holding for a second day in a row over $17,247. So it looks like it may break out of the $16,000 range to the upside if this level holds or moves higher. Anna, what do you see in Europe?
Yeah, when do we call that a comeback? And let's have a look at what we see on Europe then. And this is the picture across European equity markets. Down around 0.25% on the FTSE. More than that, 0.5% weaker on the DAX and the CAC. Off earlier lows, though, for European stocks, just in keeping, Matt, with what you were saying there about US futures. And it has been the hawkish commentary from Fed officials that seems to have weighed at the margin, at least, on sentiment. But other assets seem a little more confused. Commodities, FX, more difficult to pick out an obvious trend there, even if we are a little bit risk-off when it comes to stocks. Although Europe playing catch-up with the US of yesterday a little bit there. To Matt's point about crude not moving very fast, certainly that is the case with Brent. 79.68. Worth reminding ourselves how far we've come, though, from those levels of 120 back in the summer of last year as we continue to watch that China reopening story. The euro at 107.40. Again, not on the move all that much, but I put this in because, of course, we're focused on the growth story out of Europe and the way that the Eurozone in particular navigates through the winter and the energy challenges. The same applies to the UK to some degree, but interesting to see that Goldman Sachs coming out with a revision upwards to their estimates for growth in the Eurozone for the year 2023. And they've gone from suggesting we'd see a contraction of 0.1% to growth of 0.6%, which in economic circles is a pretty big deal, a pretty big move. So worth noting that the euro at 107.41, the pound at 121.77. Some slightly gloomy news for a few months in a row when it comes to the recruitment sector. That seems to be the dominant headline in terms of the UK macro today. We've got strike activity ongoing. We'll get an update on that later. Euronav is a stock listed in Brussels, down by 17.6% today, Matt. This is a shipping business, of course, a maritime business. They had been the subject of a bid from Frontline, which is owned by a billionaire, and now that Frontline offer is not going to happen because one of the shareholding families in Euronav, they own about 25% of the business, has raised objections.
All right, we'll continue to watch what's going on with that. Right now, I want to get back to the big Fed story. Two officials from the central bank say that the Fed probably needs to raise benchmark rates above 5% before pausing and holding for some time, for a long time, according to Atlanta Fed President Raphael Bostic. He reiterated the central bank's commitment to tackle inflation, saying they will have to hold their resolve. And San Francisco's Mary Daly said it all depends on inflation data.
Starting point is the SEP, putting it between 5.25 and 5.5 if memory serves. That's a reasonable place to start, but we're going to need to go in and imagine as the data roll in, do we need to go higher or can we stop a little earlier? I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that, but that's where I'm putting it right now.
Bloomberg's Danny Berger joins us now for more. So, Danny, what should we expect the fallout from this to look like in markets and then from Powell later on?
There's not a huge amount of fallout at the moment when it comes to the market movement, Matt. Yes, there's potentially a little bit of tightening. You do have some higher pricing on rate hikes, but still the terminal rate, this market is pricing below 5%. And after June, you still have that pricing where we have cuts, despite the fact we continue to hear from Fed speakers, again, Daly there, Bostic, saying that it's going to be 5% or more. We're likely to hear that from Powell as well. But there's just a fundamental disagreement, it seems like, happening in markets and Fed speakers. Fed speakers, Powell, really focused on wage growth. They want wage growth to come down to a level that's commensurate with 2% inflation. But it seems like the market is buying this narrative of immaculate disinflation. You can see it in the dollar, for example. For our radio listeners, I do have a chart that does show a drop in a dollar at a 7-month low. This is sort of the belief that you don't need a huge uptick in unemployment or even potentially wage wage growth, a fall in that to bring down inflation. But again, the Fed continues to be focused on it. So it's likely that this disagreement could continue for some time, even if we do get CPI this week that comes in slightly lower.
Yeah, and for every time we hear Fed officials focus on the labour market, we hear market participants talk about how it's lagging data, and we go round and round. Danny, thank you very much. Bloomberg's Danny Berger with the latest on the Fed. We'll wait for Jerome Powell to speak a little bit later on today. He's at a symposium in Sweden. Now, President Biden met with Mexico's president yesterday at the North American Leaders Summit in Mexico City. According to a readout from the White House, the two discussed migration issues and drug trafficking and reiterated their support for democracy in Brazil. Joining us now with more is Bill Farries, a Bloomberg editor who has extensive experience covering U.S. national security matters. What stood out to you then, Bill?
Well, you know, from the U.S. side, the focus is really on the border. The Democrats have been seen as weak in terms of, or having vulnerabilities in terms of immigration policy and the flow of fentanyl over the border. So those are a couple of the top priorities that the Biden administration wants to discuss. On the Mexican side, those are issues, but they also would love to talk a little bit more about investment and trade. Mexico would really like to benefit from this idea of friendshoring, getting companies with operations in China to maybe relocate some of their manufacturing centers to places like Mexico. But trade is not really one of the highest priority issues for the Biden administration. It's thinking much more squarely about how to deal with this influx of migration at the southern border.
Yeah, that seems to be really the focus, Bill, and it makes me kind of wonder what Justin Trudeau is going to do. Does he just hang out and drink while the other guys talk? I mean, it doesn't seem like Canada really has much to bring to the table at this meeting.
Well, the U.S. and Canada do have a shared interest in trying to find ways to expedite crossings at the northern border. There's been an issue with some delays in the electronic system used to help expedite people through border crossings and airports. So that's something that the Canadian government has signaled it really wants to make progress on with the U.S. But I think from the U.S. side, that high priority is how to deal with this vulnerability at the southern border that I think they feel politically vulnerable on heading into 2024.
Bill, thank you very much. Bloomberg's Bill Farries with the latest on that meeting of the three leaders. Let's turn our attention now to the banking sector, where the deal slump is hitting the bottom line. We're joined now by Bloomberg's Charlie Wells with details of what we've heard from Jefferies. Jefferies reporting a 57% decline in its fourth quarter profit. Charlie, good morning to you. So what is behind this?
So that's a serious slump. And when you look into the numbers, you really see that it's investment banking deal flow that has really hurt Jefferies. Of course, Jefferies is a pure play investment bank. They saw investment banking revenue down in the fourth quarter 52%. But it's a more nuanced story here. And I think it's one we're going to hear more about as more banks report over the course of the week, because those numbers actually beat estimates, right? So estimates were at $550 million for revenue. They actually got to nearly $570 million. And the bank was quick to point out that they had their second best full year investment banking revenue ever. So it's complicated because we're comparing to a bumper season for earnings in the past few years, but actually investment banking revenue hit levels above 2019.
Will earnings be similarly negative as larger Wall Street banks report later on? I think on Friday we're due to get a slew of Wall Street banks.
Yeah, Matt, the bulge brackets are coming through. And I would say Jefferies is sort of like a pigeon in a coal mine, not necessarily a canary, because it's not the best indicator that we have going forward, but it gives us some sense of how investment banking revenue will probably stack out at some of these larger banks. But of course, these larger banks offer different products. They will give us an indication of, how mortgage revenues are coming. They'll give us an indication of how, net interest income is going to play out. And more broadly, how the American consumer seems to have fared in that fourth quarter. Which could give us a better sense of where the economy is heading. And the really big indicator that I'm looking for in these big banks is their bad loan provisions. That will give us a sense of how bad some of these larger banks think the economy could be going forward.
All right, Charlie, thanks so much for joining us. Bloomberg's Charlie Wells talking to us about the Jefferies results and then what to expect coming out on the 13th. Again, on Friday, we have a slew of bulge bracket banks reporting to kick off Q4. Now, let's take a look at some of the stocks moving in the pre-market trading today. Apple is pushing to replace the chips inside its device its devices with homegrown components. That's been an ongoing trend for the company. It means dropping components from other companies. Broadcom is one that we're talking about today. A key Broadcom chip will be swapped out. Also swapping out electronics from Qualcomm in 2025. So these are two on the list after Apple has already replaced largely most of its Intel products. It is Broadcom. Apple is Broadcom's largest customer. It accounted for 20% of the chip maker's revenue in the last fiscal year, and investors could worry about that going forward. You can see Qualcomm, though, the only one really moving in the pre-market. Microsoft is in talks to invest $10 billion in the owner of AI service ChatGPT. That's according to Semaphore. It's part of a funding round that could value OpenAI at about $29 billion. And CVS is said to be exploring an acquisition of Oak Street Health, which runs primary care centers for Medicare recipients. A deal could be reached within weeks that would value Oak Street at more than $10 billion. You can see those two, well, certainly Oak Street moving very dramatically in the pre-market, up 35%. Anna?
Yes, certainly dramatic moves there. Coming up on the program, we'll talk about dramatic moves in FX markets. Valentin Marinov joins us, Credit Agricole's head of G10 FX research and strategy. And top central bankers are attending an international symposium at the Riksbank in Stockholm. That event currently taking place. Among the speakers today, Governor Andrew Bailey of the Bank of England, the BOJ's Kuroda, both of those on stage right now, along with Isabel Schnabel of the ECB. You see her speaking there. They're all in a panel together. Later on, we'll be hearing from Fed Chair Jerome Powell. We'll continue to monitor the event and bring you any headlines. This is Bloomberg.
To our primary objective of price stability. As we and other central banks worldwide have started to raise interest rates, we have faced fierce criticism regarding our role in fighting climate change. There is a concern that high
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance, the early edition. We are simulcast on both radio and television, and we're looking at European stocks that have started to outperform pretty significantly U.S. stocks. We're indeed seeing that happen for the first time in many years, and it's coming to a point where it's starting to mean something statistically. What? I'm not 100% sure because Daniel Curtis put this chart in log, and I don't really get it. I could pretend, but let's be honest. Joining us now is Ksenia Galuchko, Bloomberg Equities editor, to tell us why this is happening. Certainly, we've only had a few trading sessions this year, Ksenia, but if you just look in normal percentage terms, Europe has outperformed the U.S. so far.
Absolutely, Matt. Yes, it's been a stunning outperformance. So since the very end of September, Europe has outperformed the U.S. by a lot. And it's not just in local terms, but also in dollar terms. And the main reason here is China's reopening and also the abundance of value stocks in the European market. The U.S. is primarily suffering from the huge impact of mega-cap tech stocks really weighing on the S&P 500 performance here. If you strip out the tech, the S&P would be performing the same way Europe has.
Ksenia, good to see you this morning. So there are clearly lots of reasons why a lot of investors are getting excited about European stocks. China reopening is one of those, and a lack of exposure to those vulnerable tech stocks perhaps also. But when you talk to macro strategists, a lot of them talk about how the ECB is going to hike more this year than the Fed. And I wonder how much of a headwind that could turn out to be. We're just hearing from Isabel Schnabel of the ECB. She's saying policy must turn restrictive to fight inflation. Inflation will not subside by itself. So keeping up the hawkish narrative, and yet we're still supposed to see the upside for European stocks.
Absolutely. That's the really interesting dilemma here. So this morning, Goldman Sachs economists came out and said that they're no longer expecting a recession in Europe this year. Earlier, they were expecting a small contraction. And this is mainly on China reopening coming in sooner than expected, and also gas prices coming in lower. Yeah. So the energy crisis is not expected to be as strong. Again, this means that ECB is likely to continue hiking higher, and Goldman economists confirmed that. But at the same time, just like I said, the abundance of value and cyclical stocks and lower valuations in Europe are likely to continue driving the outperformance in European equities.
Do we continue to see outperformance in European equities that are so reliant on energy companies if this winter stays warm?
Well, it's not just energy companies. If you look at the sectors that have been outperforming the most since the end of September, it's actually banks and consumer companies. So luxury it has been doing great. And as you know, luxury companies are some of the biggest in Europe. Take LVMH, Kering, some of the biggest outperformance on this China reopening. At the same time, yes, energy and commodities have actually been lagging behind this year as gas prices, oil prices are starting to subside. And banks, of course, benefit from those rate hikes that are expected from the ECB and the Fed.
And over to U.S. stocks then, Ksenia. I mean, Morgan Stanley's Wilson is saying don't buy U.S. stocks in this any latest bounce. He says that we could see a 22% slump from current levels. Goldman's Costin also seeing the 2023 earnings story as showing estimates are too high. This doesn't bode well stateside, I guess.
Well, so I was looking at the Citi Earnings Revisions Index the other day, and actually the deepest cuts right now compared to Europe, compared to the world, are for the U.S. market. So I think analysts are going into this season very pessimistic, and that way the earnings can actually outperform their expectations. That often happens. So currently, the rate of those earnings cuts in the Citi Revisions Index is the deepest since early 2020, since the peak of the pandemic.
That's really interesting. Yeah, so a bit of catch-up maybe a bit happening there in terms of estimates from US analysts. Ksenia, thank you very much. Bloomberg's Ksenia Galuchko with the latest on the markets. And you can get more market analysis. MLIV Go is the function to use on your Bloomberg terminal if you want to read the Markets Live blog. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York, and Anna Edwards is with us out of London. Kaylee Lyons is on assignment this week. Now, keeping you up to date with news from around the world, here's the first word. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order for the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. The UK's attempt to send the first satellites into orbit from its own soil has failed. A rocket launched from a Virgin Orbit Boeing 747 that took off from England suffered a malfunction. That led to the loss of its payload of 9 satellites. The jumbo jet and its crew, though, returned safely. In college football, Georgia has won its second national championship in a row. The Bulldogs destroyed TCU 65-7 in a game that was more or less over before halftime, maybe even before the coin toss. Georgia quarterback Stetson Bennett threw for 2 touchdowns and ran for 2 others. And the former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg has learned that Nishad Singh met with federal attorneys last week. A Singh cooperation deal would leave Bankman-Fried increasingly isolated because 2 former FTX executives are already working with prosecutors on their own deals. So it looks like everyone's coming in looking for a little safe harbor, Anna, and it leaves Sam Bankman-Fried out in the cold with his not guilty pleas.
Right, there's certainly a story that we'll continue to watch as we work our way towards the autumn, towards the fall, where we maybe get more on that. And catch Bloomberg Crypto today at 1 p.m. New York time, at 6 p.m. in London with Matt. That's our weekly show that covers the people, transactions and technology shaping the world of decentralized finance. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Federal Reserve's next move. Two Fed officials see interest rates rising above 5% as the central bank fights inflation. Summit in Mexico City. The leaders of the US, Canada and Mexico meet to discuss everything from trade to migration and climate change. And Jefferies is the latest to fall victim to Wall Street's deal slump. The firm's profits plunge in the fourth quarter. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today. And Matt, a sense that perhaps the markets are waiting after we've heard from some hawkish Fed officials already in the past 48 hours or so, waiting to hear from Powell and then crucially waiting for the inflation print later on this week.
Yeah, for sure. We're all waiting for that. The question is, will we continue to see the kind of pickup in volume that we saw yesterday? Big jump in volume yesterday. Will that continue today, or will traders sit on their hands? Take a look at what's going on in, well, what's not going on in U.S. markets. S&P futures, you know what? Go ahead and go back to bed. Nothing changing here, and the U.S. 10-year yield also isn't moving very much. 355 is the level there. At least we have a little bit of move in crude, in gold, in Bitcoin. So some of the commodities and or currencies, depending on your view, are changing price. NYMEX crude, WTI up to almost $75 a barrel at 74.92, a little bit less than 0.5% of a gain there. And Bitcoin, I think more interestingly, holding above $17,000. It's been stuck at 16,000 and change for so long, and now it seems to be breaking out of that range. I say it seems to be because we've seen it give us a couple of head fakes above 17 and then drop back down. But right now, $17,265, and that's the second day in a row. In terms of pre-market movers, there's a lot more action in single stock stories. Apple, for example, pushing to replace the chips inside its devices with homegrown components. This has been a long-running story for Apple, but Broadcom is the next in line to get hit. So pay attention to Broadcom as well as Qualcomm in today's trading. Apple itself isn't moving much at $130.14 in the pre-market. Microsoft is up about 0.2% at $227.60. It's in talks to invest $10 billion in the owner of AI service ChatGPT. And then CVS is looking to buy Oak Street Health, or exploring that option of an acquisition of Oak Street Health, which runs Medicare centers, for $10 billion as well. And as a result, Oak Street Health is up 33%. Anna, what do you see in European markets?
Yeah, we see a little bit more movement here in Europe, but we're kind of playing catch up with yesterday. Here in Europe yesterday, we had a decent session, whereas US stocks faded and ended the day a little more mixed. So we're catching up with that, really. Stocks Europe 600 down by 0.6%. We've had some quite hawkish commentary, of course, overnight from Fed officials, and that reminding us of their likelihood of getting rates above the 5% level. Brent crude, just checking in with that. Not much movement there on Brent either. So even though we're sort of risk off in stocks, we're kind of playing catch up, and FX and commodities markets doing their own thing, really. 79.81 is where we trade on the Brent price, well down from the 120s level that we saw last summer, despite the fact that we're all talking about China reopening. It's a complicated relationship, it seems, there between that story and what happens on various commodities. The euro is at 107.37, pretty flat there as well. I mentioned last half hour that we were following this Goldman Sachs story. They've revised their growth estimates for the Eurozone for this year, for 2023. So they don't see a contraction there anymore. They don't see recession. They don't see a drop of 0.1% in GDP. Now they see growth of 0.6%, which is quite a sizable upgrade, just underlining the vulnerability, I suppose, of the economy, or the gearing of the economy to energy prices in that upgrade there. Euronav is down by 16.5%. This is a shipping business. The billionaire, John Fredrickson, had been making an offer for this through his business Frontline, another shipping business. Euronav's shareholders, though, not keen. It seems at least one large family, a historic family that has a 25% stake in this business. They are not keen, and so as a result, that deal is going away. The stock is down by more than 16%, Matt. But overall, a little bit risk off in stocks, but a more complex picture in FX.
Right. It makes sense, risk off in stocks because of what we heard from the Fed, really confirmation in my mind that they want to hike to 5% or above and hold. Let's see how it is moving the FX world. Joining us now, Valentin Marinoff, head of G10 FX Research and Strategy at Credit Agricole. So, Valentin, we've got a couple more Fed speakers out saying, look, rates are going to have to rise to 5% or higher, past 5%. And Raphael Bostic said, look, we're going to have to hold for a long time. It's not going to be this turnaround and pivot that the markets seem to keep pushing for. Is that moving anything in the FX world?
Well, certainly the markets are ignoring the hawkish rhetoric, and that is not helping the dollar. I mean, if you look at the rate differentials, a key FX driver, what this is resulting into is really a rate convergence, really with currencies like the euro, other like Aussie, really catching up with the dollar. Us investors seem to be playing a theme where other central banks will be catching up with the Fed having peaked. I think ignoring the Fed really, or indeed its hawkish rhetoric, is an inherently risky strategy. Last week, the December Fed minutes have warned that similar, seemingly dovish interpretation by the markets is actually resulting in unwarranted easing of the financial conditions, and actually could mean that the Fed will have to do even more. So from that point of view, I think the markets are trying to call the Fed's hawkish bluff, but that may backfire spectacularly.
Okay, good morning to you, Valentin. So do you see some of this dollar weakness then as a little premature? Because looking at your notes, you do see dollar weakness as one of the big FX themes of 2023, but what, it's too early?
Yeah, indeed. I mean, the speed of the adjustment has been quite aggressive, and I think that at least some of that will reverse in the near term, especially if the Fed now doubles down and tries to push aggressively against the dovish market interpretation. So really, just calling the Fed's hawkish bluff could end up in tears, I think, for some investors. So from that point of view, if you think of a situation where the Fed continues to push rates higher towards 5.25, potentially higher, and as a result, Treasury yields resume their rebound higher, and that coincides with further weakness in the US, European data from here, that is a recipe for risk aversion. That is a recipe for more or renewed dollar demand. The high-yielding safe haven could be back.
Okay, and where does that leave the euro versus the dollar, either in the short term or further into 2023? We've heard from Isabel Schnabel at the ECB. She's speaking at a conference along with lots of other central bankers in Stockholm today, saying that policy must turn restrictive to fight inflation. So ongoing, hawkish sentiments coming through?
It's a matter of credibility, how credible the central bank's message is, right? So for a long period, like last year, the Fed's message was clearly seen as much more credible than that of the ECB. The fact that we're having a mild winter in Europe and China reopening playing a role, that is lending credibility to the hawkish ECB message. However, there is a problem with that in the sense that we're still to see the massive tightening in the European financial conditions that's going to result on that. If you just do the math and think of how much of the debt that the governments in the Eurozone are planning to issue this year, right, in how much of that the ECB will no longer be buying, and essentially the private investors will have to absorb that flow, means that yields for EGB yields like Bund or essentially BTP yields will have to go higher and higher and higher. And we are still to see that tightening in the European financial conditions, which could hurt growth, could actually mean that a mild recession will be very difficult to avoid. And as a result, the credibility of the ECB's hawkishness could be eroded once again. So in relative terms, I think euro-dollar peaking close to current levels. So near term, we think that the return towards 105 or potentially lower could be on the cards.
So you see a higher rates environment for Europe. You see that as necessary to persuade investors to take on the government debt that's going to be issued. How does that stand up against, for example, Goldman Sachs this morning upgrading their estimate for European Eurozone growth from minus 0.1% contraction up to plus 0.6%.
Well, we're seeing, I mean, we are still in the camp of a mild recession. We do believe that there's going to be a significant consumer retrenchment, as in domestic demand really suffering under pressure of still persistent stagflation headwinds. I mean, commodity prices, energy prices have come off a bit, but they're historically very elevated. And energy prices in Europe are likely to remain multiples of what they are in the US and in Asia. There's a huge blow to the European competitiveness. So even if China is reopening, chances are that the profits that those exporters will be generating will be far less than what we've seen in the past. So the euro buying, as they convert those profits back into the euro, those flows will be far less really in historic comparison. On the top of that, tighter financial conditions could hurt the lending channel in the Eurozone. The banks' lending will be impacted. So as a result, I mean, struggling to see Europe avoiding recession at this stage.
What do you think about the BOJ here, Valentin? I mean, we've seen some real movement in the yen. Obviously, there's movement in the dollar. That pair has gone from, I think, 147 to 130. Do we get more movement from the BOJ exacerbating that move?
Well, I guess that's one of the crosses that did get us by surprise. We were expecting some depreciation of dollar-yen, but essentially where we are at the moment is very much our year-end target. So just the joy of really forecasting the FX markets in full display there. In terms of what's driving it on the dollar side, I think I mentioned that, but on the BOJ, I think the investors are jumping the gun a bit prematurely. Yes, we did see the widening of the yield curve control band in December, somewhat earlier than we were expecting, but we doubt that the BOJ will be abandoning its yield curve control policy anytime soon. So from that point of view, we think that dovish disappointments could be on the cards at the upcoming few meetings. And again, going back to the point about the credibility of the hawkish rhetoric that's coming from the different central banks, or the less dovish rhetoric that's coming from the BOJ, I think that investors may be too aggressive, assuming that the BOJ will be easing out of yield curve control anytime soon. As a result, dollar-yen interesting buying opportunity at current levels.
We just saw pictures, by the way, of Kuroda speaking at a Riksbank conference in Stockholm. He's talking about very big picture stuff. He's talking about the impact that climate change could have on prices and on growth, saying that they can't respond unconditionally. But again, that's huge picture. And we want to know more, Valentin, about yield curve control, don't we?
Well, indeed, that's been one of the key really factors that has been driving dollar-yen, the expectation that the BOJ will no longer find that policy useful. However, we think that with the 10-year JGB yields having already adjusted a bit, and that distortion that was so apparent in the JGB yield curve having corrected, at least to an extent, makes us think that essentially any complete abandonment or removal of that policy won't be necessary this year. And I should also mention that in terms of valuations, essentially dollar-yen is very much where it should be, given the levels for treasury yields, JGB yields. However, we do believe that the markets are underestimating the hawkish resolve of the Fed. So as a result, we actually would expect treasury yields to resume their rise before too long, which makes us actually bullish dollar-yen from current levels.
Okay, bullish dollar-yen from where we stand right now, 131.98. Valentin, thank you very much. Thanks for joining us. Valentin Marinov of Credit Agricole with his thoughts on FX markets. Coming up, we will turn to American politics in the broadest sense. We're live in Mexico City, where the leaders from the US, Canada and Mexico are gathering. More on what to expect next. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute.
The Canadian Trade Minister there speaking with Bloomberg's Anne-Marie Hordern about energy policy at the North American Leaders Summit in Mexico City. Anne-Marie joins us now for more on the summit. And AMH, it's likely to be, our focus is likely to be more on what the U.S. and Mexico have to say than Canada, right? Because it's all about the border this time, isn't it?
Yeah, when Justin Trudeau joins the bilateral today, a lot of the discussions will be about trade, but you're absolutely right, Matt. And yesterday, a bit of a contentious meeting at times, you can say, even though they've really done their part to try to show a warm relationship between AMLO, the Mexican president, how he's colloquially known, and President Biden, picking up at the airport, driving with him to his hotel, a big hug and embrace before the bilat. But there's some difficult issues when it comes to migration, although they just struck a new deal, which would mean more migrants being absorbed into Mexico at the border, but really when it comes to drug smuggling. And you can see a lot of time in the U.S. readout from this bilateral meeting was spent on the drug smuggling, not just the fact that they have this shared security concern about narcotics like fentanyl, but that the U.S. administration really wants to put pressure on Mexico and is working with them to go after the chemicals that lead to the making of fentanyl, go after the laboratories, go after the drug cartels. And for Mexico's part, before this meeting, they could show that they are trying to do that. They got a video of Guzman, El Chapo's son. He's now detained and arrested. But this is something that is a political issue in America for the Biden administration. Fentanyl deaths is the #1 killing of individuals aged 18 to 49 in the United States. Admiral Kirby talked about the fact that at the border they seized 20,000 pounds of fentanyl since August. This is a huge issue across America, and the Biden administration wants to work with Mexico to get it done, to try to stop some as much as they can that illegal crossing on that border.
And the Mexicans, of course, want to take part in the trade conversation with Justin Trudeau that you mentioned is set to happen later. Are they going to help out Biden on the immigration and fentanyl situation, the broader opioid problem, in order to get more of that trade?
Well, I'm not sure they would exactly frame it as that, which sounds very much like a quid pro quo, but this is something AMLO is asking for. He wants the development banks with the U.S. backing to come in and help them create more projects like clean energy. They want to be a hub and expand the nearshoring that is already happening between these two countries. They want to be a place where companies can diversify. They want the components for the semiconductor manufacturing that's happening in the United States now that the U.S. is putting a ton of money in to come from Mexico instead of, say, coming from a factory in China or in Asia. So they view this whole diversification away from Beijing as a real win for them, but they still want more support. But the trade issues are also going to be quite contentious as well, especially when it comes to energy policy. Mexico will say it's their sovereignty, but Canada and the U.S. say what they are doing is nationalist energy policies. It is not in line with the USMCA. And at this moment, and you heard from Mary Ng there, Canada's trade minister, they're in these discussions, but she says all things on the table. So at the end of the day, if this is not wrapped up, we could see tariffs on Mexico from these two countries.
So we could. Anne-Marie, so trade is being talked about. Drug trafficking, you make clear, is a priority. Migration, also a policy priority. But Brazil and events, unrest further south, no doubt in danger of overshadowing this gathering, especially as former President Bolsonaro is actually in the United States.
That's right. He's in Florida, and there was lots of, videos of him going around in the new year, eating at a KFC and at a Publix in Orlando, Florida. Anna, for you in London, it's quite a well-known grocery store like, say, Tesco in the UK. But now he's hospitalized. And this has overshadowed the event a little bit because you had a joint statement, the first one from Trudeau, AMLO, and Biden was on Brazil and how they condemned the riots in Brasilia. For the Biden administration, they're coming under some pressure from progressives like Representative Joaquin Castro of Texas and Alexandria Ocasio-Cortez of New York to extradite him. They say that he should not be given refuge in Florida. So Bloomberg News reporting, and a great scoop by my colleagues, is talking about the fact that they're behind the scenes. The Biden administration is looking at what potentially are these avenues they could take to maybe either push Bolsonaro and convince him to leave or potentially revoke his visa. A lot of questions are in the air, but this story is not going away.
Okay, currently hospitalized, but I know that Jake Sullivan said that the administration hasn't received any requests as yet from Brazil to extradite the former president. We'll watch that story. Anne-Marie, thank you very much. Bloomberg's Anne-Marie Jourdain reporting there from Mexico City on the meeting of three leaders and the violence that's been taking place in South America. Now, coming up, cutting energy support, what the new plan from the UK government could mean for business. We'll put that in a wider European context as well. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Liz, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is on assignment. Now let's take a look at what's ahead today. This morning, central bankers Jerome Powell, Andrew Bailey, and Haruhiko Kuroda are among the speakers at the Riksbank Symposium in Sweden. We've already seen some live pictures of Kuroda there. Then at 11:30 Eastern Time, France will announce significant retirement reforms. Unions have already warned about massive protests and strikes against those reforms, so watch out for yellow jackets. Later on, Mexico's president, U.S. President Joe Biden, and Canada's Prime Minister Justin Trudeau continue the North American Leaders Summit in Mexico City. We were just talking to AMH about that, and trade is next up on the agenda with the three amigos. And then, Anna, in the UK, the Treasury is announcing it's going to cut into energy support there.
Yeah, absolutely. So you might remember that the Truss government put in place, as short-lived as it was, some support for households and businesses. Well, now the Treasury under Rishi Sunak has announced it is cutting energy support to businesses and bringing in a new, smaller program from the month of April. That was widely expected they'd do that, but now we've got the details of what that means for UK businesses. Bloomberg's Lizzie Burden has details here. And Lizzie, the good news is, I guess, that gas prices have been falling. So whoever's paying the bill, whether it's corporates or it's governments, that's going to be better than, say, it was last summer. But they're still relatively high.
Yeah, relatively high, triple the pre-crisis level. And as you say, the government is cutting support for businesses on energy. To just put it in comparison, the former package was worth £18 billion over 6 months. This new package is worth £5.5 billion over 12 months. But the Treasury says it's simply unsustainable to permanently shield businesses from the energy shock from the war in Ukraine. You have had a backlash from the business lobby groups. UK Steel has said that competitors in Germany are getting more support from their government, so UK producers are going to be at a disadvantage. And the Federation of Small Businesses says that companies are either going to have to cut jobs or go to the wall unless the government coughs up more cash.
By the way, British nurses and ambulance drivers pushing ahead with more strikes next week after failing to reach talks with the government. What do we know about the possibility of a deal there? I think the world is watching and hoping that your NHS nurses get paid.
Well, I am hoping that the transport workers get paid so I can get on the trains instead of cycling in, Matt. But we have had some softening of the government's stance. Over the weekend, the big question was whether Rishi Sunak would consider negotiating on this year's pay, not just for 2023, 2024. Now there's talk of backdating pay, so perhaps meeting somewhere in the middle. There's also talk about one-off payments to help workers deal with the cost of living crisis now. But the government is still tabling its anti-strike legislation today. You mentioned about France. Ministers have been pointing out to similar legislation in other European countries on minimum service levels. So you can see the example they're trying to follow there.
Lizzie, thanks very much. Bloomberg's Lizzie Burden with the latest on the ongoing strike activity. Negotiations with unions continue and the government. That is it for Early Edition. Surveillance is ahead. Tom, John and Lisa will be taking you through the market moves. They'll also hear from Olivier Blanchard, Senior Fellow at the Peterson Institute of International Economics. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
This is Bloomberg.
What Fed is indicating is that they are willing to put up with a lot of pain.
The market's going to give the Fed not much credit, frankly.
Whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done.
If we tip into a recession, you could have a fair amount of earnings weakness.
The recession is not a question of if, it's a question of when.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Waking up to a little bit of optimism this morning from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Julian Emmanuel of Evercore alongside us. We'll catch up with him in just a moment. Equity futures right now on the S&P 500, negative almost 0.1%. TK, call after call. Goldman Sachs dropping its Eurozone recession call in the last 24 hours. Morgan Stanley getting super bullish on Chinese assets. Just a little bit of optimism, a constructive view, TK, this morning.
What are they going to do on Friday after the inflation report? Everybody's going to recalibrate off that report. No and for buts. I mean, it's all there is to it. I get the euro recalibration right now, but what I would look at is the elephant in the room is the Bloomberg Financial Conditions Index before we go to commercial break may go positive. There is absolutely no way I would have guessed that 3 weeks ago.
Does Chairman Powell push back against that in 3 hours' time?
It's not should. He has to. Even the people that are looking for a more accommodative Fed need a chairman that can say, no, we're just not going to be that accommodative.
If you're long risk right now, are you fighting the Federal Reserve? Chairman Powell speaking at about 3 hours' time. Lisa, HSBC, Max Kettner, bearish through the whole of 2022. Then this morning, we change our view.
Yeah, and it's interesting that it's happening in the second week of 2023 to show you how quickly things are moving and how much sentiment is shifting. Basically saying that originally it was that it's going to dip and then rip, right? We had been talking about that. It's going to be a bad first half.
You said dip and rip.
That was you. I'm going to say that. That was you. That was 100% a John Farrow branded saying. But then he said it's going to be reversed, that it's going to be a better than expected first half, and then it's going to be a worse than expected second half, and that now he's actually neutral on stocks, overweight on credit, and neutral on cash. In fact, in some ways, underweight. So this is just a complete recapitulation of his original view.
I'm looking at Julian Emmanuel, and he's just itching to jump in on this. Julian, dip and rip. I think Mike Wilson and Morgan Stanley asked yesterday.
We don't do this for Ed Hyman.
We wouldn't do this for anyone else.
We're going to come off this. Only Ed Hyman would get this treatment.
Mike Wilson turned around and said, how is the consensus wrong? He thinks it's not the direction, it's the magnitude. Max Kettner coming out this morning saying first half might be better than people expect. What do you say?
Well, look, you know that we're in the dip and rip
camp.
I know.
Okay? And frankly, being in the consensus has always been a point of bother for us. But when you look at it, you're fighting this whole notion that the Fed is going to hike at least 50, maybe 75 basis points more. And the ISMs, both manufacturing and now services, are in recession territory.
Sub 50. Sub 50, and people still want to buy this market. We'll talk about it in a moment. Equity futures right now down 1/10% on the S&P. Julian is going to stick with us. That's not the length of the interview. We'll catch up with Julian in the next
Thank you, Julian.
couple of minutes. Just let him go. We'll speak to him again as well about Europe. China reopening and getting bullish on Europe. We're going to talk about that too. Futures negative then, yields up about a basis point on a 10-year. Your yield this morning, Lisa, your 10-year, 354.67.
A lot of people leaning into the long bond kind of trade. Can the Fed push back enough? I just want to say yesterday, Atlanta Fed President Raphael Bostic said, I'm not a pivot guy. So perhaps Fed Chair Jay Powell says something similar. 9 a.m., Jay Powell does take part in a panel discussion on central bank independence. He is speaking at the Riksbank in Stockholm. He will be followed by a host of others, including ECB Governor and Council member Pablo Hernandez, DeCos and Klaus Knott. They're also speaking, but later in the day around 10:30 a.m. Eastern. How do they talk about the move in the markets? Tom, you mentioned the easing of the financial conditions. They will have to push back against this. What can they say that's actually going to get the market's attention? Right now we're looking at two-year yields in the U.S. that have come off, that have actually plateaued. But in Germany, people are buying into the story that it is going to be a hawkish ECB, partly because of that optimism, partly because you have seen a reversal of some of the bearish calls with Goldman Sachs saying that Europe is no longer going to enter a recession. Does the ECB kill that excitement by saying, okay, now we raise rates and we raise rates a lot? So that has been the tone, and that has been recognized both in FX markets as well as bond markets. And at 1 p.m., the U.S. will test the waters. And this is actually interesting, and Tom, I know you're going to laugh, but the U.S. is selling $40 billion of three-year notes. It comes at a time of so many questions around what's going to happen with short-term yields. The Fed, one member after another, coming out saying we're going to hike above 5%, and we're going to keep it there for a very long time. The market not buying it again and again and again, basically plateauing, significantly lower from some of its recent
Is there something, is there something, John, called auction gloom?
Auction gloom.
Auction gloom.
I spoke to Lisa for about 2 minutes this morning, and she sounded almost constructive, endorsing some of the views we got from Max Kettner and HSBC. Lisa will be back in the studio. She'll weigh in on that in just a moment. Julian, let's start here with Chairman Powell. 3 hours away. Tom mentioned it. Financial conditions have eased somewhat. Do you think he pushes back against that?
He does.
Do you think it works?
Here's the issue. The issue is there's a lot of positioning going on in front of Thursday's CPI. So from the aspect of a cap being on risk assets, like we saw basically 2 hours into yesterday's session, it probably does work. But it could be an entirely new narrative after that report comes out.
Your shop invented the synthesis of equity analysis and economic analysis. A guy from Texas did this a few years ago. Synthesize right now the enduring Ed Hyman belief that America clears itself like nobody else. We will get through higher rates. We will get through all the tech layoffs and all the other drama that's out there. Synthesize the optimism on your floor right now.
Well, point blank, Ed has been of the view a good 9 months now that inflation is going to fall faster than the market believes. And thus far, it's starting to materialize. His full-year inflation forecast is 2.5%. The golden two handle, okay? That is an entire new set of circumstances for the Fed to deal with if, in fact, that's right. And you know, that is probably in and of itself the argument for risk assets that we think materializes at the end of the year.
At the end of the year, but not at the beginning of the year. And this is what I wanted to raise, because I actually understand what Max Kettner is getting at, and people who are saying, wait a second, the data isn't that bad. There has been a change in facts with better than expected weather, warmer than expected weather, and a China that's reopening. Why isn't that enough to sustain things for a bit longer before people hear what Raphael Bostic is saying? I am not a pivot guy.
Look, no question about it. The surprise to me when I got to the green room was to look at natural gas and realize it has a 3 handle on it after what we've seen the last several months. That's a big deal. But at the end of the day, we have this set of circumstances where the Fed is intent on reining in the labor situation. And the only way you do that at this point is to cause I wouldn't call it a material slowdown. But look, Ed is looking for a couple of negative GDP quarters, what we used to call until the first half of last year, a recession.
Okay, and I understand the dig there, as a lot of people are saying. It didn't actually happen. So what causes the rip? What causes the upside if the Fed is determined to bring inflation down, if they're really going gangbusters there, and you don't necessarily get some sort of fiscal impulse or anything to really drive things in the other direction?
It's essentially this idea that there is a terminal, endpoint to the hiking. You don't necessarily need to see the easing, and the market is probably, and I think we're going to hear this in a few hours, incorrect in believing that there's going to be any sort of material easing in 2023. But what it really is what you have every time at market bottoms. There has never been a bear market bottom without a capitulation, without an emotional volatility spike, and that in of itself clears the playing field for the next bull market, and we think that's going to happen.
If I'm not 100% in cash, where am I? What sectors have value and have protection?
We continue to think that value has value, okay? It is going to be challenged for the next couple of weeks at
dividend
a minimum.
growth?
That's part of it. Look, we're very defensive-minded right now. Consumer staples, healthcare, and energy continues to be, it's sort of the piñata back and forth, with waves of emotion and, ticks in the oil price. But at the end of the day, even if we dip into a recession, energy is 5% of the index weight and is going to account for 9% of the earnings this year.
So you don't think tech can regain leadership here? It's basically the message.
In the short term, it absolutely can. But in the long term, look, the fact is that the investing public still owns too much FANG.
You're a student of market history. I think what we're all leaning on here is this idea that it's incredibly rare to get a market low before the recession. Isn't that basically the argument here?
Yeah, in a nutshell, absolutely. It would look, again, we have to take it from the jump-off point that everything that we've seen in the last 3 years is about, has very little, if any, historical precedent. But this is one of these things. The entirety of 2022, we were asked, when's the capitulation? When's the catharsis? When's the emotion? It's coming.
And this ain't it yet. Seems to be the message. Julian, we get lucky. Going to stick around. Going to talk about Europe as well. Just the optimism, all of a sudden, not just the China reopening, but we mentioned a number of months ago, the number one thing you needed in your outlook was a meteorologist to come by and give you the weather forecast for the Europeans. And that seems to be the change.
It is a surprise. And frankly, it's in the United States as well. Not so much that we're as warm as them, but we're not freezing, et cetera, et cetera. But I do agree, John, that has been the magic pleasant surprise.
My phone was lighting up this morning. Tadeo just ping, 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 message. Have you seen this? Have you seen this? Goldman dropping its call. Deutsche Bank saying perhaps we could escape recession, Bramo. Just message after message, research note after research note saying the same thing.
But this is where a price can determine the sentiment, because right now some of the other indicators are also moving the other way. Small business optimism just came out below estimates, just to give you a sense. So there is that as well.
Well, I go back to what Julian said. We've got ISMs at negative 50, or rather below 50, in contraction territory. The ISM, Julian, when was the last time the Fed hiked with the ISM sub 50? Do you know that?
It is.
When was the last time it happened?
There's only been a couple of precedents for it. We actually ran that yesterday. As I said, just a couple of times, and the outcome has not been terribly pleasant over the near and medium term.
It's a very unique moment for this Fed, Tom. Incredibly unique.
Well, yeah, and these comments this morning. When's he speak at 9 a.m., is it?
9 a.m., yeah.
Yeah, 9 a.m. So this is a morning event, folks, as we get into Thursday. And, I think the summary here is important. It is a toxic brew of dip and rip. I mean,
a toxic brew
it's
of dip and rip.
It's a toxic brew of dip and rip.
I will say, we're going to spend a lot of this morning teeing up this conversation at the Riksbank with Chairman Powell. Spoke to Mike McKee yesterday. It's unclear how much he's actually going to address current monetary policy, so perhaps bear that in mind, that we might tee this up and then get absolutely nothing. We hope we get something. There's a Q&A session in the mix as well.
We better get something.
They better ask good questions. In the next hour, Amy with Silverman of RBC. Julian Emmanuel sticking with us. Maria Tadeo out of Europe up next.
Keeping you up to date with news from around the world with the first word. I'm
I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. A Singh cooperation deal would leave Bankman-Fried even more isolated. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. The measure is not expected to pass once it's sent to the Democratic-controlled Senate. Attorneys for President Biden discovered classified documents while packing up the Washington office he used after serving as vice president. The White House says the materials were turned over to the National Archives. The Justice Department is reviewing the matter. Former President Trump is under investigation for his handling of classified materials at his Florida estate. In the UK, ambulance drivers will go ahead with another strike planned for Wednesday. A senior union representative called the government's latest effort to avert more strikes in the health service an insult. Prime Minister Rishi Sunak is facing pressure from his own Conservative Party to fix the crisis. And Bloomberg's learned that Microsoft is in talks to invest up to $10 billion in the creator of artificial intelligence bot ChatGPT. Now, proposal calls for Microsoft to invest the money in OpenAI over a period of years. The two companies have been discussing the deal for months. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in Focus, Thursday on Bloomberg.
The Fed is actually not data dependent here. They're path dependent. They've essentially chosen a policy rate at or just above 5%. And the goal is to get there and then hold that level in place for an indefinite period of time, most likely, the balance of this year, unless the economy crashes or financial markets crack.
My data was fantastic yesterday. The chief economist and macro strategist at MKM Partners from New York. Good morning to you all. Equity futures just a little bit softer. We're down 0.25% on the S&P 500. In about 2 hours and 40 minutes, you'll hear from Chairman Powell. We'll bring you his address at the Riksbank in full, of course, and get you all the headlines from Mike McKee as well. Equities down, yields are higher by a couple of basis points, 3.55, and euro dollar back with a 107 handle on the euro, 107.35, and Goldman dropping its recession call, saying the following: we no longer look for Eurozone recession, reflecting better growth momentum, sharply lower natural gas prices, and earlier China reopening. We upgrade our Eurozone forecast notably above consensus. Maria Tadeo joins us now out of Europe in Brussels. Maria, where is this Eurozone optimism coming from?
Well, Jonathan, there is bullishness today this morning. There is something in this environment. You talked about that note from Goldman Sachs. They dropped their recession call. They now see positive growth of 0.6% this year. They talk about this mild temperature. The reality is we were told this was going to be the winter from hell. I had a very nice 3-week break in Spain, and the temperatures were not freezing. We have seen actually better than expected weather. Gas prices have dropped massively. That removes a lot of the risk premium. And then, of course, the China reopening, which they say will be good for made in Europe. Funnily enough, we also had a note from Deutsche Bank almost an hour later that essentially said when you look at the PMIs, it looks like this recession can be averted, and also noted this China reopening also positive for the euro.
Maria, you covered the ECB. No doubt that if we can escape that recession, this ECB is just going harder, isn't it?
Well, if you remember back to that December meeting, she repeated many times, Madame Lagarde, that she was not going to pivot, that she was going to continue to hike no matter what, that they were going to be restrictive, that there were no limits potentially to the actions that they could take, that this was the #1 priority, and repeated so many times there is going to be no pivot. So that's where she left it, and that's, of course, where I guess she would want to repeat and pick up in this new year. But, of course, you know, this data, will it change something for them? When you look at Goldman Sachs, in their note, they say 50 basis points in the next 2 meetings, 25 basis points in May. That's what they predict.
Maria, thank you. Maria Tadeo there on the latest out of Europe. Euro strength, dollar weakness. The dollar, DXY, is down almost 10% from the highs, Tom, in late September. That's quite a move.
We had a momentary print of a 102 handle, which is a huge deal. It's a huge signal. This is the major trading index. Bloomberg Dollar Index is more sophisticated, more varied, has China in it as well. You know, this is a raging debate among FX people. Mark McCormick to join us here. Is this a weak dollar trend yet? Jane Foley pushed against
Is it the real deal? 103 on dollar index right now. Julian Emmanuel of Evercore alongside us in the studio today. Julian, what do you make of all this euro optimism we're waking up to this morning and this dollar weakness we're seeing as well off the back of this China reopening story?
In the immediate term, it may be a little bit in terms of the reaction of euro dollar at 107. That's understandable. But the bigger picture is that what the last 9 months have been about is ridding the Eurozone of the psychology of negative interest rates. It's very difficult to overstate how important that is for risk assets, for investors, you know, assessing capital allocation decisions, you know, in that part of the world. And frankly, when you think about the discount for over a decade, during which time the dollar rallied almost consistently, it makes sense, the case for Europe.
What's revenue growth do if we get an Ed Hyman inflation scenario, which is a 48 or 52, I can't remember, even into outright deflation in the early 50s? What does corporate revenue growth do given a rapid disinflation?
It's certainly going to decline, and it's going to decline faster than the market expects. Is it going to go negative? Very unlikely, because frankly, again, you have the other side of the fact that you've got so much stock of consumer savings, and in that environment, one might be able to argue that you're going to have, I wouldn't say a soft landing, but not a crash, to call it over 5% in the unemployment rate. And so you're still going to have that backstop that gets you through the shallow recession to the recovery in 24.
If this is true, Does that mean that the Fed, the ECB, can remove accommodation completely, go from negative or zero to 2, 3, 4% without causing a financial crisis, without causing a crash, a normalization that just leaves a couple potholes, but not that much more along the way?
It's very difficult. It's literally only happened in 94, 95. And interestingly enough, when you look at 94, that was the only other year in the bond stock quadrant where you had negative returns to both bonds and stocks. Granted, they were nowhere near the scope of what we saw in 2022, but the upside is it is possible.
But we reverted back to low yields after that, and it really entered this decade, these 2 decades, 3 decades of the incredible bond rally. If we don't get that, if this is the new normal, maybe not this high, but a 3% Fed funds rate, an ECB rate of 2%, does that mean that we can just live with that? That it just is basically money isn't free, but it's not going to necessarily cause some complete re-rating of stock and bond returns for a longer period of time?
It is possible. It's going to compress multiples. It's going to compress leverage. It's going to compress valuations across assets, but it isn't a deal killer. And at the end of the day, it doesn't depress materially the concept of earnings and earnings growth, which is what drives stock prices.
In Europe, this goes beyond the weather. This seems to all go back to China. I think so many of the calls that we're seeing this morning are underpinned by this more optimistic, constructive view on China reopening. Morgan Stanley were pretty blunt about it. We believe the market is underappreciating the far-reaching ramifications of reopening and the possibility that a robust cyclical recovery can occur despite lingering structural headwinds. So I'll make it really simple. I think for a lot of people waking up this morning in the market, they want to work out whether they should be investing in a story where growth slows or investing in a story where growth rebounds. Which one is it?
We think there's a very good case to be made for China assets right now. In fact, our China strategist, Neo Wang, thinks we get to 6.2% GDP growth.
This year?
Yep.
Wow.
Yep.
That is stunning.
Yep, exactly. And
the ISI Evercore Asian economist feels they get a 6+ handle.
Yep.
Wow.
Absolutely.
John, what we're talking about here, in my head is spinning over where we were 3 weeks ago. I believe 3 weeks ago the world was ending as we know it. And now we've got all this optimism here, and only one thing has changed. Disinflation in Spain, disinflation in France, some other place I can't remember. This stunning 6% call, stunning 6% call on China, and what are we going to see Thursday in the United States?
So I'll answer my own question. I guess it depends where you look. If you look to China, things look better. If you look to the United States, maybe things look worse. And Julian, just as a final question, that tees up the question we ask almost every single January, every single year, is whether we can get outperformance ex-US, whether that's where the outperformance is. International markets beyond US shores. Is that where it is?
So it's been a fits and starts type of argument. And again, if you look at the broad sweep, it's because of the prevalence of negative rates in much of the rest of the world and because the dollar has rallied. We think that we're not saying you're in a dollar bear market, but the dollar has topped in our view, and that is absolutely tailwind for rest of the world outperformance.
Julian, this was great. Julian Emmanuel of Evercore in the studio. Thompson, massive calls on the Chinese economy and the FX market too.
Yeah, and also Ed's idea of disinflation in America, but without question, the hallmark call this week away from what we're going to see Thursday is Evercore ISI with a 6% plus China GDP. That's monster. I'm sure I've missed somebody, but to me, that's like you say, it's a monster.
That's above Goldman as well.
I'm not focused
above
today. I'm sorry.
Morgan Stanley, I believe too.
I'm off.
Are you distracted? Why?
I'm distracted because somebody said the TOTS may go on sale to the
to a Qatari investor.
You know,
right?
what's that?
Wouldn't you like the money?
Me.
Wouldn't you like the money?
I don't know.
Would you like to front a consortium?
Can Harry block this?
Harry might be going to United. Just in that, some chat about that too.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?